Good morning, good day, or good evening, wherever you are. Welcome to the Investor Expo show for December 12th. My name is Anna. I will be your host today, standing in for Jack. Grab a cup of coffee, make yourself comfortable, because we have prepared for you a great lineup of 4 speakers.
Well, hi everybody. Thank you for stopping by today. What I love about this particular get together is that the fact that these talks are only 45 minutes long, and really there's no real selling in this. They've asked us to just present our ideas as an educational kind of thing, and not be here really to sell you things. At the end, I'll give you an email address. If you want to write me about something, I will show you in the last 60 or 90 seconds of the presentation. You can. But that's what I love about this. It's really all for the attendee, and the fact that you're not going to be not going to get a few facts that you already know and then bombarded with selling. So let's get going with what I got for you today. Now, I'm different from Barry and all the other speakers that are here, and pretty much any place that I speak and go, because my wife and I, Tisha Hallett, my wife is a subconscious trainer, as well as being versed in things like EFT and TFT and NLP and all the things involved with the mind and how you think and act. And as traders, we tend to pay a little bit too much attention on the trading plan and how to execute that without giving much lip service at all to the mental and emotional issues of trading. And you've probably heard that 90 some odd percent, 91%, 92%, depending on the study that you see. And there are some studies where they've taken trading receipts, weeklies and monthly from trading accounts, and taking a look at how and these transactional firms, and taking a look at who wins and who loses, and the losing percentage of traders is in the 90% range. And the other thing that I wanted to mention is that there are about 90% of the traders that give no or very little attention to the mental and emotional issues of trading. And I think there is a direct comparison. I believe that if you are a struggling trader out there, there is hope for you, but I want you to also understand that that hope likely resides in the area of mental and emotional management, and that's what we're about here. So we kind of stand alone. It's not a sexy thing. People don't like to admit that they're the problem. They're their own reason why they're losing. They've got a pretty good trading plan or a very good trading plan, and yet it's not working. It's not happening. But it's not them. It's the market makers, or it's the tweeting from President Trump, or it's something other than I'm not in full control of my trading plan. And so I want to emphasize to you the importance of the mental and emotional issues. And I want to go give you today 2 powerful ways to build and maintain your self-esteem and self-confidence as a trader, because self-esteem and self-confidence really is the base of where you're going to wind up as a trader. It's the base of your ability to control yourself and everything around you. Okay, so just a little bit of background. Why should you even listen to myself and Tisha? Tisha's not here with me today, but that's us on our 39th wedding anniversary, and it's been great. I know it's been great for me, and I think she'd say the same if you asked her. But I picked this picture because we looked happy. So a little bit about me. I've had 39 years experience in the area of investing and so on. I've worked, if you look on the right, Payne Weber. I was a specialist in the futures market for Payne Weber. I ran one of the largest option firms in the country back in the 80s for International Trading Group. I've had my own, I've managed several $1 million for large-scale investors in the Hallett group. I also had my own introducing broker where I did transactional work with clients and so on, besides running my own accounts. And really the last 20 years has been involved in the disciplined trader, where my wife and I are zooming in on the mental and emotional issues and helping traders with that. And I've written a few books, one on how to build a trading plan, another one This is actually a CD that that is a video of a presentation that I did, More Profits, that's being sold. And of course, the book that everybody seems to like, the inspirational quotes from the Disciplined Trader. It's more of a kind of a coffee table book with just inspirational quotes from all the videos that I've done over the years. And I've done hundreds and hundreds of them on specific topics around the mental and emotional issues of trader. My wife, she's got all these things after her name, which must mean something, and it does. It's all her certifications in as a clinical hypnotherapist, a neurolinguistic programmer, a thought-filled therapy and emotional freedom technique, which you may know as tapping, the tapping solution. I don't know if anybody out there ever heard of the tapping solution. Why don't you give me a chat, and I can kind of see whether anybody's actually done anything with the tapping solution. Very interesting. We use a lot of that with our one-on-one work with clients. Okay, there we go. You can see Tisha's graced the cover of many different mental training periodicals. She's written books not only in the area of trading, but in area of she wrote a book on how to find the right partner for women. And we came out originally, the Disciplined Trader. We started something called Subconscious Training Corporation, where we made software for golfers and tennis players and salespeople. In fact, we still sell much of that, even in CD form. Now it's in online form, but a lot of that to some of the best golfers in the world use our software as far as the mental and emotional trading. And Tisha has lectured, as you see, all over the world. So enough about us. This is why maybe what I have to say should have some bearing, maybe possibly on what on your interest and you know where you're going. All right, let's talk about self-esteem real quickly. The definition is in psychology, the term self-esteem is used to describe a person's overall sense of self-worth or personal value. It's really a base. It's where it's the most base form. It's where everything else comes from. In other words, you need to. So, well, let's look at it this way. Self-esteem is often seen as a personality trait, which means it tends to be stable and enduring. It's the base by which you operate. It can be involved in a variety of beliefs about self, such as the appraisal of one's own appearance, beliefs, emotions, and behaviors. So self-esteem is the very base of say, the triangle of how you feel about yourself, your ability to be forthright, your ability to be proactive, and so on. And we have to be proactive as traders. So self-esteem is that base it's I think self-worth and personal value really are the important terms in understanding what your self-esteem is. It's your base of positive belief. Okay, self-confidence is a little bit different. It's more of a proactive thing. It's drawing from that base of self-esteem and then using that base to be proactive with where you want to go with your thoughts and ideas and your convictions. It's self-confidence, confidence in oneself or one's own ability. A strong, positive self-confidence is critical to your ability to achieve. Again, that proactive nature that we need to be as traders. We need to, when our trading plan gives us a trading signal, we need to take that trading signal in a proactive way without hesitation. We've tested our trading plan. We understand that it works on the long term. We know that losses go along with wins, so that we get 2 or 3 losses in a row. We're not bailing out. It's how much confidence you have to achieve, to be proactive, to move forward successfully toward your goals. Okay, so you've got your self-esteem, you've got your self-confidence. Together, they give you a base as a trader. The worth, the self-worth, and then the confidence in your ability to do things, and then boom, your strong and positive self-confidence to actually achieve and to be proactive and to make your moves. Okay, success. So the combination of both strong positive self-esteem and strong positive self-confidence, we need that as a trader. We need those as a trader, and that equates into a success base as a trader, where you have a strong positive expectancy. And it really all winds up to the trader as positive expectancy. In other words, we expect to succeed, We know that we're not going to succeed on every trade, but we have the positive expectation that over time we're going to be successful in what we're doing. And to maximize your strong positive expectancy, there are two things perhaps that you want to concentrate on, and these are the two things that we're going to discuss today. One, or I'm going to give you some critical aspects of money management, risk management, and with a twist about the emotional risk. Because really, when you're managing your money, when you're managing your risk, you're really reducing. If you do it properly, you're reducing the emotional risk. And this is just as important, this concept. I call them both number one, staying out of the gap. Gap is a concept that I will explain to you. It's a belief gap that as traders we need to make sure that we don't fall into this particular gap. So let's get to the money management. You got to ask yourself a question. Before I start, are you hearing me okay? Are you kind of with me on this? If somebody wants to just comment in the chat, I just make sure that I'm being heard, and just give me one person who is if I may not be able to. I think I'm accessing the chat. Let me do it right here. I'm going to write hello. Just, you can write anything you want, but can we get one person to? Let's do the entire audience. Okay, great. All right, somebody woke up then, which is good. All right, how much of my account am I willing to lose in order? How much of my account am I willing to lose in order to have a decent chance of the return that I'm waiting for? I mean, that's what you're always measuring your risk reward in money management. And one thing that I believe is the main element that most traders don't give enough mind to is the concept of position sizing. How many positions are you taking on? How many shares, if you're a share trader, are you trading? Because this it determines your expected drawdown, and of course, as you do the math out, your annual return expectations. Maximum emotional risk then would be having deep stops when you put on a trade and a high number of positions. Okay, that would be your maximum emotional risk, because you're taking your biggest risk by using deep stops and at the same time having a high number of positions or shares. The great part about it is if you're right, you're going to score big. The bad part is that if you're wrong, it's like a punch in the solar plexus. And I'm going to show you a little chart in a second that really is, you really don't want to take these big risks where you are setting yourself up for even a very small possibility of having a loss in the 2 digits, 10, 20, 30% loss. These are devastating to the almost said the broker, to the trader. The minimum emotional risk would be, of course, very short stops and a small number of positions. This is many times what we do. Maybe not so much the shallow stops, but you're using a minimum number of positions when you test. And then when tests go well, somehow when you do it for real, you start increasing your position size and so on. So I always make sure that when somebody has a good test, that they run their real money when they decide to take real risk with the same parameters that they use their testing, so that they can see it work in real time with real money before they start increasing their position size. The good part about having shallow stops and a low number of positions, that if you're wrong, you're not going to lose a lot of money. But if you're right, you're not making a lot of money either, and there's a lot of frustration from an emotional standpoint that comes in. So there's a mix of the two, and you need to be cognizant, because the truth is that the right combination for you is somewhere in the middle. Stops that reflect the right support and resistance area. If you're taking a long trade, you want to have your stop underneath the major resistances. If you start to choose supports, if you have a long trade, you're putting your stop under the supports. And if there are always minor supports, and those are, I believe, a little bit higher risk. They're more likely to get hit as a minor support. the major support. So you have to recognize major and minor support so that you can, in long trades, so that you can try to stay under the major support and have a lower number of positions or shares. This is usually a better way of approaching things. For the more action-oriented trader, then you may want to go with dealing with the less strong supports, the minor supports, and knowing that you're going to have more losses involved. Okay, so your best approach again would be patient to wait for an A+ setup to enter a trade, where you have a high profit potential and a low loss potential. Those are usually somewhere in the 2-to-1, 3-to-1 areas. Sometimes you can find an A+ trade in a 1.5-to-1 reward to risk. Okay, you need to size your positions according to the spread between the risk and reward. So if you have a very high, if you've come across an excellent initiating signal where your trading plan tells you to get in, and you've got a 3-to-1 risk reward, that may be the time to put on more positions than your average number of positions that you put on, because your reward is higher, looks as a very good measure against your risk, and you're doing it with a high probability signal that you're getting, or high probability setup. This is an A+ trade. All parameters should be committed in writing to your trading plan. So you need to define what the perfect trade is for you, and then have the patience to wait for those A+ trades. Because if you look at your trading, if you look at your monthly statement, I think you're going to see that it's the A+ trades that have more of the success than anything other than an A+ trade. So in the end, if you have the patience to wait for the A+ trades, which is going to wind up meaning that you're going to take fewer trades but have higher percentage winners, these are the right kind of ratios that you should be looking for. Here's that chart I mentioned to you. I always show this chart when I talk about risk and management. In several of our courses, we hit hard on this risk and management thing. But this is a chart that I keep in front of me, and people, traders who are opening their 5th account and keep getting blown out. This is a very important chart for them. You've got to understand that if you take a 10% drawdown, you're going to need to see the rest of the 90% of your equity come back 11%, a little over 11%, to get back to even. At 20%, you need to see a 25% increase in the remaining capital. But boy, once you get to the 40, 50, 60%, if your account is taking losses down here, and 50%, you've got to double your money. If you're going to give up 80% of your money and try to come back, you've got to make 4 times your money just to get even. So preserving your capital and waiting for that A+ trade, the high probability setups where you have a low risk compared to the potential reward, those are the times that you have. So you've got to be patient and wait for those times. Okay, so I want to make sure that I got that out to you. All right, here's some rules of capital preservation, and then I want to explain the gap to you. You got to be shy about pyramiding. I've seen people really get in trouble with pyramiding because they tend to have different parameters as the market continues, especially in their favor. It's never a good idea to pyramid on the way down, because generally, if something is not working out for you, you don't want to complicate that. But very, very few times. It's just the time that it happens for you, where you buy down, and those wind up to be the better positions, the one you put on 2nd and 3rd, and then you make a big profit from that. All of a sudden, you believe that's the way to go, and it really isn't. Pyramiding, I believe, should be done from a winning position. Only pyramid winning positions, and only when they continue to reflect favorable risk reward. So each time that you put on a new position, you need to assess the risk reward ratio of that new position. The first position you may, and here's in one of the trading plans that I run, when I'll put on an initial position or 2 positions, I trade a lot of futures, so I may put on a couple of gold positions. If the market continues in my favor, say on a long trade where we're going higher, my stop will be usually against a major support level. Okay, as the market goes higher and breaks a resistance level that then becomes a support, a minor resistance level that becomes a support, that may be a good place to put on another position with the stop on that second position below the minor support. So if you catch my drift, you know, I don't believe that you want to be a person. I've seen very few trading plans that work out where you're pyramiding, you're putting new positions on, and you're moving and you're keeping a break-even stop all the way up. So if the market corrects sometimes a third of the way or halfway from the original place that you got in, put on your first position, you're out at break-even. And that's what you'll do a lot of the time if you always put that stop riding up on break even as you add positions, and you keep on adjusting that stop higher as you add positions higher. So I want you to kind of take a look at past charts, what would have happened if you did that. And I think you see that pyramiding should probably only be done on winning positions, and you need to place your stops in responsible places on the way up. Okay, risk only a small percentage of total equity on each trade, no more than 2% of your portfolio value. I think most traders have understood this. Again, every even great trading plan is capable of 4 or 5 losses in a row. Even 4 losses in a row would get you 8%, even in each of those trades with 2% maximum risks. So you know you're staying, and that's an odd occurrence to have 4 in a row and 5 in a row. But even at 5 in a row, you're not blowing yourself up. You're playing the odds that the next one, if you stick to the 2%, 2 to 1 and 3 to 1, that the next one will start to recover, because odds are, we used to say that if you have 3 or 4 losers in a row, then odds are that you'll have the winner next. But as we know, it's almost in a 50-50 trading plan. You know, it's a coin flip. So I don't know what kind of trading plan hopefully it's a 60 or 65% winners or more. Number 3, limit total portfolio risk to 6%. In other words, if you stopped out at every position in your portfolio, you'd still retain 94% of your original trading capital. When I say total portfolio, I know for me, sometimes I'll have a gold position on, I'll have silver, I'll have a gold and maybe a coffee. Sometimes I'll have 3 or 4 positions going at the same time. All of those positions, if they all went south and I would not able, and I lost in all those positions the maximum set amount, it would not exceed 6%. So if I have my first 2 positions, or my first 3 positions on, if I have the first one at 2%, the second one at 2%, the third one at 1%, then if I put on a 4th trade, it can't be risking more than 1%, because otherwise it would add the addition of the 4 trades would be over 6%. So you catch my drift there. You've got to pay attention to your portfolio risk as well as your individual trade risk. Also, got to be realistic about the amount of risk needed to make a profitable trade. Don't make a trade if it doesn't fit your risk parameters. Okay, you don't want to make a trade fit your risk parameters. We tend to do that when we're positive about something, about a situation, especially when it's highly political in our minds. You want to make sure that you're not talking yourself into something. I've got a whole section on that, but we'll do that some other time. And number 5, risk reward. A reward to risk minimum of 2 to 1. I prefer 3 to 1 for an A+ trade, 2.5 to 1. But I've had A+ trades that I mentioned as 1.5 to 1, because I do believe that that there are probably some patterns that if you care to look back, especially if you've been trading a particular system for more than a year, you can look back and I think you can identify pretty much which trading plans, which trading configurations and signals are going to give you the highest number of wins. And so I can, it's very seldom, but I can find a 1.5 to 1 risk reward. But really, those 2 to 1s and 3 to 1s, they can really make your portfolio smile. Lock in at least a portion of windfall profits. You know, the thing about mentally, when a market starts to go, you can think about this, you can't help but escape the idea, boy, this is a big winner. This is the one that I've been looking for. You know, all of a sudden, people who were, this morning, gold was up $13, $14. People were looking at it approach the $1,500 level again. Anybody who shorted that market is up $1,500 a contract right now, if not more. and you can and if they put on 2 contracts, you may think to yourself, wow, this could be the big one. If this thing goes down $20, $30, $40, I can make $8,000, $10,000 in a day. The best move is to go ahead and take one of those positions out of a quick windfall profit like that. You know, because markets can reverse one way as quickly as they've gone the other way. So listen, you've got that one on for what I call lewd and lascivious profits. So do not be greedy. You want to, from a capital preservation standpoint, you want to lock in at least a portion of windfall, because what happens more of the time is that you take it off and it backs up and you say, wow, what a genius I am. And you're only a genius because you wrote it in your trading, in your journal, in your trade, and you have it in your trading plan, okay? Number 7, the more active I am, the less I will risk on each trader. This may sound counterintuitive, but the more active you are, I think you want to keep your risk as low as it can be, because as you get active, you start to get highly excited about what's going on, and you're moving around, you're checking prices, you're just active, and I think that may divide your focus a little bit, and you know that's where you may tend to jump at emotional decisions rather than when you're focusing on one trade and sticking specifically to a trading plan with total focus. So the more active I am, the less I will risk on each trade, okay? Now, number 8, never add or average down to a losing position. We talked about that. There are some, I did years ago, I traded something called scale trading, which is by definition adding positions on the way down. And I can tell you right now, in the end, it may work for a year or two, but in the end, it's going to be a losing proposition. And number 9, the last one we'll talk about today from under the management, is be willing to stop trading and reevaluate the market on your methodology when you encounter a string of losses. And the number that I use is 6. I've seen some really good trading plans with 4 or 5 losses in a row. It's that number 6 that starts to make me think that maybe maybe the market is out of phase with what I'm trying to do with a trading plan. And I back off, and I look back at charts and in the markets that I'm trading, and really dig in on why because many of the times you look back and you made a stupid mistake, or you moved to stop, and and you thought it was part of the trading plan, but it was something that you eliminated last week, but somehow because you were running 2 or 3 positions, you do it. So you need to, when you get a string of 6 losses, go ahead and stop, look back at your trading and see what's happening. Okay, got 15 minutes left, and I want to give you at least 10 minutes right here on avoiding the gap. The gap is about the skill of being a happy, positive trader. Okay, the ideal is a mental construct. That's what the ideal is. It's like the horizon. Okay, ideally there's a horizon. We can walk toward the horizon. The horizon, of course, is where the sky meets the ground. Well, the sky doesn't meet the ground. We know that, but it's a mental construct. We've given it a definition. It's a perception. And so, but as we walk toward the horizon, we may continue to walk and then run and drive a car, but you're never going to get there because it's a mental construct. It's not achievable. For us, the ideals of being one of the richest people in the world, or having the biggest house on the block, and so on, these may of course, some of these things can be achievable, but from a day-to-day standpoint, you can't measure yourself against not achieving that. I've seen people, for instance, wanting to make $500 a day on a $10,000 account or a $15,000 account. That's hard to do when you're keeping the risk parameters in order. And so, so you've really got to be careful when you start stating things to yourself. What happens is you may make $500 the first day, and then the second day you're $200, and then $300, and then you lose 500, and so on, and all of a sudden you're behind. You're supposed to be making $2,000 on your $10,000 for the month, and it's the 15th of the month, and you're down $100. You say to yourself, well, I better get aggressive here. And that's not the way to trade. Those kinds of goals are not, because you're setting up a mental construct that may get further and further away. Look, it's, you know, I play a lot of tennis, and I play a lot of doubles tennis, and when my partner and I, if we fall behind, we always say to each other, 1 point at a time, 1 point at a time. Let's take 1 point at a time. Because if you win a couple of points at a time, you start gaining momentum. It is the same in trading. Okay, so think about the ideal for a second. It's like it's like the horizon. It doesn't exist outside our minds, nor is it achievable. You know, I want to be the richest. Some people have real grandiose ideals. Okay, it allows us to set goals and it motivates ourselves. So there's nothing wrong with wanting to be richer than Gates, so that you can be philanthropic the way he is, and his wife. You want to motivate. It motivates us to withstand difficulties and hardships. And then the definition of a goal, on the other hand, is a specific measurable result that's inspired by the ideal. So the goals are these steps that you're taking in order to reach the ideal. The thing about the ideal is that when you say, if your ideal, for instance, is at this point is getting a new Mercedes, when all of a sudden you start walking and achieving goals toward that ideal, you change that ideal. All of a sudden, a Mercedes is not good enough. I want a Bentley. You know, it looks like I can get a Bentley. So what happens is, as you start achieving, the ideals keep moving out. So it becomes something that you never actually achieve, because as you're going through the achievement process and following your trading plan, then all of a sudden you want more. You want more for your family. You want more for that. So the ideal is something that's really not achievable because you keep moving it out. Okay, I hope you get that. So you need to learn to avoid the gap. And I'm going to tell you what the gap is. There's an actual. All right, here it is. There's an actual, which is where you are right now. Where are we right now? The actual achievements of life, internal or external. And this gap psychology could be in any part of your life. I'm talking about it here in the midst of trading. Now, the gap is the permanent difference between the actual and the ideal. In other words, as you achieve, and you're now a step ahead of the old actual. Now you're an actual plus something, plus whatever, wherever you're going, plus a step in the right direction. And rather than measuring yourself against the fact that you didn't reach the ideal, you're better off, and to stay positive, you measure yourself from where you came from. Here's a little chart on it. Okay, here's where we are right now. Here's where we were last week. Okay, let's say you want to make $500 a week in a $10,000 account. Well, and say that's somewhere near that's the ideal. Well, let's say you made $200 in the week and not 500. There's two ways of looking at it. And some people call this half full and half empty. You want to stay away from the half empty thing, okay? Because here, if you started with $10,000 and you wanted it to be 10,500 at the end of the week, and all it is 10,200, you can say, hell, I didn't make it this week. I'm not going to be able to achieve a goal of doubling my money in 6 months. It's not going to happen. Maybe I should. You start changing your thinking, and because you're giving a negative reaction to a positive result. Hey, you made $200. So why not stand at actual 2 and look back an actual 1 and say, hey, I may have not have made 500, but I made 200. I'm going in the right direction. I'm on the right track. So as you achieve your goals, small though they may be, okay, you do not measure yourself against the ideal, because when you do, you're in that negative territory. That's the gap, where what you have achieved compared to what you dreamed of achieving, and measuring yourself against that. Somebody who makes a considerable amount of money, you hear it all the time. Oh no, but I've lost. I lost more than that last year. Come on, you just made $10,000 in 2 months instead of waiting 6 months. You're doing great. Yeah, but I lost 20,000. Half full is not going to help you as a trader. Always measure yourself against where you came from, and not not the ideal. That, again, it's a mental construct that keeps moving. You're never going to get to the ideal, because you're going to keep expanding, and you should, because an expanding and growing ideal, it continues to motivate you. Okay. So hopefully you get that concept. So between the idea of keeping your risk and money management under control in a responsible way, and keeping positive by rewarding yourself. And even if you lose $200 in a week rather than making 500, the fact that you can recall a couple of trades where you kept your stop in rather than moving it where you wanted to, it would have been worse. Always look at the positive things that are going on, because just like positive momentum, negative momentum, just like positive momentum can hurt you, negative momentum, positive momentum can help you, negative momentum can hurt you. So if you're measuring against the ideal, okay, if you're measuring your achievement against the ideal, you're going to feel like a failure, you're going to be frustrated, disappointed, you're going to have guilt, depression, and the worst part is that low self-esteem. Again, that's the base of where you're coming from. Measure yourself against where you came from. Small achievements should make you feel terrific. I celebrate everything that I achieved, no matter how small. Even the small losses, again, I've learned to celebrate because they weren't big losses. And I think you got to learn to do the same thing. Because when you measure yourself against actual one, where you came from, then you're going to nurture your success. You're going to feel satisfied. You're going to have more confidence. You're going to be enjoying yourself more. You're going to be more optimistic. And most of all, you're going to lift that base of belief that you have as a trader, high self-esteem. Okay, so those are the most important things when it comes to, I believe, keeping your positivity and that positive expectation in order, controlling your risk in a responsible way. The key word being patient to wait for the key thought is being patient to wait for the A trade and keeping your risk low and compared to the potential reward, and staying out of the gap, which is the distance between what you have achieved and the ideal, which is like the horizon, it keeps moving. Okay, so stay out of the gap, appreciate how far you've come, and make new goals. Make new goals to go even further. Okay, I want to show you something now. I hope you enjoyed that, and I hope you took a couple of notes. Especially, you probably follow a lot of the things that I've talked about in the money and risk management area, but there may be one or two in there, especially about pyramiding, that you really want to take note of. Okay, but I have a question for you, and if you don't mind writing this in the chat, we have some quiet people here today. In the chat box, I'm hoping I'm accessing it correctly, but what is your answer to this question? Okay, what is your primary thought or emotion that has you trade in a way that compromises or hampers your trading success? What emotion or thought is getting in the way, causing you to make mistakes? What is that primary, the most important one, the thing that keeps on recurring and you keep saying, God, I did it again? What is the primary thought or emotion that has you trade in a way that compromises or hampers your trading success? I'd love to hear what that could be from some of you. All right, losing money. Okay, we all don't want to lose money. Do we have any other thoughts here that you can give me? We have several dozen people here. Just give me a thought or emotion. I won't take care of my family. That is a lot of people want to, of course, take care of their families. Any other that we can see here? Anybody else want to contribute? John, more don't want to lose money. Okay, very good. I can't read that one, but yeah, I hear you, Phyllis. All right. Any more? And because I just want to give you a concept here. All right, because I want you to hold that thought. What's your primary thought or emotion that has you trade in a way that compromises your trading success? Because really, we are, again, as I led off here in this talk, where we stand in our own way as traders. Most of us have pretty darn good trading plans if we can follow them and stay confident with them. Okay, so what if I offered you an unlimited number of one-on-one coaching sessions for a full year? That's the way I may be able to help you. Okay, unlimited one-on-one coaching sessions for a full year. We call it laser coaching. It's a personalized mental and emotional money, and this is not thousands of dollars. That's the crazy part. You can have as many coaching sessions with us. It's up to you. You request one, you get one. Okay, we have a calendar you pick from, and Now, how can we do this? How can we offer traders unlimited coaching on their mental and emotional issues, and maybe some trading issues if it involves, if you've hooked it to a mental and emotional situation? I can help with that. Tisha can help with that. It's Tisha and I working with you one-on-one. Why laser coaching? We can do it because this 15-minute coaching sessions emphasizes focus. These coaching sessions, we call them laser coaching because they're only 15 minutes long. And we use either, Tisha will use with you neurolinguistic programs, she'll use a meditative type, and all of these 15-minute sessions that we have with you, they're recorded so that you can redo them and do these sessions on your own but once you solve that situation, or if you're having trouble solving that situation, even then, go ahead and book another 15-minute session. Just throw it on the calendar. It could be the next day, could be the next week. Okay, you can have 5, as many as you want. Okay, the only thing that we ask you is that when you have a coaching session, and there are things that we want you to do, like take this meditation once a day for a week or whatever, and we'll make a special one for you, then we want you to do that before you have a next session. But other than that, if you do what we've asked you to do in that one 15-minute coaching session, then make another session, and you can have this. And some people really take advantage of this. We've just rolled this out, but we're already seeing we've had a much more extensive coaching, but this is actually working, I think, better. It emphasizes focus. When you only have 15 minutes to focus in on your problem, you don't get flowery. You get right to it. And that's the best part of it. We can zoom in on what's really affecting your trading. It isolates the predominant behavioral issue to eliminate, okay? With unlimited sessions, you get timely and immediate support. I've seen coaching that's thousands and tens of thousands of dollars, where you actually you've got to wait. You have every month you have a session. What if I had a session yesterday and today something really important came up? I got nowhere to go. We also give you complete email access to us between your 15-minute sessions. If you just have a thought or idea that's kind of complicating you a little bit, boom, send us an email. We'll respond quickly. We're really good at doing that. We love to do that. So we're all about you and helping you with your mental and emotional issues of trading, okay? The laser coaching program gives you fast results for your most pressing issues, leaving plenty of time to work on other issues that are holding you back while developing positive habits to replace your former self-destructive habits, okay? Delivered to you on an online meeting platform. We use Zoom, which is great, allows you to access laser coach. We look at you one-on-one. You can do it on your computer, your laptop, your smartphone. We have a lot of people taking these sessions on smartphones, which is great. There's an app, and you zoom right into our meeting, and we go one-on-one with you, because we want to see each other's faces. Tisha wants to help you one-on-one. And just to get to the truth of your situation and make it happen. And we do it for a crazy low price. I'm not even going to show you that price because I'm not really selling. I just want to know if you're interested in learning more about this. She uses cutting edge techniques, thought field therapy, emotional freedom technique. You can look at the tapping solution. Google that. A lot of people call the emotional freedom technique the tapping solution. But thought field therapy is really the original version. So Tisha was one of a handful of therapists that were trained almost 20 years ago in thought field therapy. Now it's called emotional freedom technique. And so you've got all these, you've got the 15-minute coaching. After each coach, you receive a recording. We'll give you a recording and notes from your session. You take a session, you do your homework, you book another session. The first session is 30 minutes so that you really get to know you in that first session. If you're interested and want more info on laser coaching, just email me. It's not for everybody. Somebody who recognizes the importance of coaching. I paid as much as $10,000 a year. I'm sorry, $20,000 a year to a coach in Canada, an entrepreneurial coach who helped me a lot. And I was with him for 5 years. Imagine that. And look, it's not like that. It's not thousands of dollars. It's not even $1,000. I'm just saying to you that send me an email. And I'll give you an invite to a 20-minute explanation, and I'll show you all the bonuses we give with it. Just email me at nhallet@thedisciplinetrader.com.
Hello, can everyone hear me? Good afternoon. Almost 12 o'clock here in New York. What a day for the market. Very interesting day. I don't know if anyone has traded at all here today or seen anything. The market had a huge lift this morning, 5 minutes out of the gate. we ran up and made brand new all-time highs, and then we ended up selling off like, I don't know, 10, 15, 20 minutes ago. So it's been quite a volatile time. But anyways, today I'm going to talk about how you can really earn a living trading or make six figures a year trading, if in fact you want to do that, if you want to trade for a living. I'm teaching people how to do that. I've had my business, the Stock Swoosh, since 2012, and I've been trading since 2008. So it's almost 2020. And it's funny because it feels like I've been trading forever. I think once you get into the market and once you're doing it, you can't imagine, life without it, especially if you love to trade. And today's one of those days where every single trade works, and it definitely is a fun day to trade. If you have any questions, you can email me at melissa@thestockswoosh.com or call me at 929-3200-GAP. You can also follow me on Twitter, Facebook, YouTube, or Skype. I appear on Fox News and Fox Business Network, and I always try to tweet before I'm on television when to watch me. So let's get right into it here today. Let's focus on how you can make money trading, how you can make a living doing this, and how you can earn a good amount of money. Now, I say good amount. I say six figures a year. Obviously, it depends where you live. You may live in Ohio, and the cost of living in Ohio was very different than, for example, Manhattan, okay, where I live. So it really depends what your goals are, but I think you have to start where you're at right now, and then you have to say, okay, this is my goal for 2020, and what am I going to do to get there, okay? And I truly believe that anyone can achieve their goals if they have a plan of action and stay on that plan of action, even if you start out trading with a small account. Now, what do I mean by a small account? We will talk about some options trades today. You could trade my system using options, or you could trade my system using equity trades. So you can open up an options account with as little as $2,000. Now, if you want to open up a margin account at a retail trader, you will need $25,000. If you do not have $25,000 and you want to trade on margin as an active day trader, then you will need to go to something called a proprietary day trading firm. If you have any questions about that, you can ask me now, or you can ask me later, or you can email me as well. But you can trade at proprietary day trading accounts with as little as $2,500. Now, we're going to talk about some advanced risks today, and also I'll give some examples of beginner risk too. But the amount of money that you risk per trade should definitely be in consideration with the amount of cash that you have in your account, okay, even if you have a margin account, all right? So if your goal is to make six figures a year trading, and say you only have $2,000, you have to be realistic about how long it's going to take you to build your account, that you can take the necessary risk to achieve those goals. It may not happen overnight, but if you are strict and focused and disciplined on following and being consistent, I do believe you can do it. And again, since I've been teaching since 2012, since I've had the Stock Swoosh, one of the biggest things that I've seen, it's a commonality where why many people fail is, number one, they do not have a system that works to trade, and they don't follow any system at all. And number two, they may have one system or several systems, but they don't follow anything consistently. So therefore, they don't see the consistency in the results. So one day they're up, one day they're down, one day they're up, one day they're down, kind of like that. And that is problematic. It's problematic for your emotions. It's problematic for your finances, for your account. It's much better to be green Monday, Tuesday, Wednesday, Thursday, Friday. It doesn't mean you're never going to take a loss. You may have some trades that lose. I have some trades that lose, but more trades that I do work than fail. So this is where the consistency comes into part, okay? Because you're looking to find a structure, a strategy that you can use consistently in order to profit so that you can achieve the goals. And you should look at your goals as something like where you're going up. So it's like taking 10 steps forward and you may take 2 steps back, but you're always moving up. Then you take 5 steps forward and you may take 1 step back. Because again, not every single trade that you're going to take works. Not every trade that I take works, but way more trades that I take work than do not. Now, today is a good example, though, because every trade worked. We went long today. All the trades today were longs, although we're going to go over some trades from a couple days ago, but today was a day to go long. We went long Starbucks today, the market. Things worked today to the upside. Any questions here so far? Anyways, my point is that It is very, 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 very important to be consistent. I think it's a big key to success, but of course, you still have to have a system that works, all right? So let's talk about time of day. So you get up in the morning and you say, okay, when am I going to trade? Well, I found that the best times to trade are when? In the morning. The market's open, the US market is open between 9:30 and 4 o'clock Eastern time. However, that being said, I find that between 9:30 and 10, and today was again, no exception to that, between 9:30 and 10 a.m. Eastern time, you really have the biggest moves in the market and in stocks, the most volatile moves. Could be 10, 15, 10, 30. I'd say just to be safe, the first hour of the day, really you should block out. But usually we're done trading in the first 30 minutes of the day, okay? In that time period, you can catch a move. I'm usually trying to catch $1. And I'm using that as a rough estimate because some stocks are a little bit less expensive, 50, 60 cents is a move, but usually $1. And again, if it's more expensive, we might be looking for more than $1. Today was the Starbucks. We went long. It was almost $1. If you stayed in it all the way up, actually it was more than $1, okay? Went to 89 and changed. But in the morning is the time that you want to trade. And again, consistency as far as the time of the day. Okay, so I'm always looking to get trades in the morning. I'm always in between 9:30 and 10. And if I'm not taking trades by 10 o'clock, if I'm not in anything, then I'm probably not going to do any trades that day because I don't think anything is setting up correctly to day trade. So the time of the day that has the most volatility I've found is the first 30 to 60 minutes of the day. So if you want to make money as an active trader, again, Monday, Tuesday, Wednesday, Thursday, Friday, you want to trade in the time period that has the volatility. Volatility is a good thing. If you take it in the right direction, but you have to take something in the right direction to make money no matter when you trade. If you are going to make money and a stock is rallying, the only way you're going to make money is if you go long. Consequently, if you want to make money shorting, the only way you're going to make money shorting is if you're shorting a stock that's selling off. So you've got to get the direction right no matter what, but you want the moves, which you get when you have the volatility. So what is volatility? Volatility often refers to the amount of uncertainty or risk related to the size of changes in security's value. A higher volatility means that the security's value can potentially be spread out over a larger range of values. This means that the price of the security can change dramatically over a time period in either direction. A lower volatility means that a security's value does not fluctuate dramatically and tends to be more steady, okay? So I'm looking for volatility in stocks because I want to make a lot of money as fast as I can, because if I'm day trading, I've only got between 9:30 and 4. That's it, okay? And again, you can do options with my system and hold them overnight if you want, or you could day trade options. And we'll go over that in a little bit here. But the idea of day trading is you've got to be in and you've got to be flat and out by 4. So I want the biggest move I can get within that period of time. Okay, so volatility is something that I'm looking for so that I can play on it. It's something called shock value. Many traders are confused because they wait, and I find wait too long. They will wait and scan after the market opens to try to pick which stocks to trade and find the direction they're going, or try to predict where the market's going and take a trade late. Wait till after 10 o'clock. Or even after 11 o'clock. This can get very confusing. And again, today's a great example. Why? Because the market shot up like a rocket 5 minutes into the open and then sold off later. So you'd say, okay, what was the direction to get? Well, if you went long into the open, you profited, and you would have never shorted at the top because you wouldn't have known where that was, and the market's at the highs. So you have to be organized with what you're doing. I usually choose what stock I'm trading in the pre-market into the open. So I have it all decided, sometimes as early as 6 o'clock in the morning, what I'm doing. I'm looking for stocks that are gapping, and I'm going to explain to you what a gap is in a minute. There are bullish gaps and there are bearish gaps. Not every gap works. However, I have a system that I designed and created where I look at 26 points on a daily chart while I will determine which stock I want to trade and in what direction, okay? And I will focus on that. So for example, Starbucks today was gapping up. I knew Starbucks was getting bought. I knew it would have the follow through. You could have bought Starbucks as a call. You could have day traded it, okay? So I had in my mind that Starbucks was a good watch today for a long. I saw the gap up in the market, in the pre-market this morning. So I focus on gaps, and you can see gaps in the post-market, and you can see gaps in the pre-market, okay? You can see gaps after hours. Now, I'm not taking trades after hours. I'm watching the stocks have moves and gap after hours, okay? Does this make sense? I'm not sure if I'm looking here the right, where's the questions if there are any? Oh, let me see here, questions. Okay, I think I just saw it. And again, if anybody has any questions, let me know. I just found the question module. So anyways, I can see stuff at night. I can see stuff in the morning, but I'm not taking the trades until the live day, okay? Makes sense? But that preset ahead of time, me deciding, me looking, me figuring out, me getting myself ready mentally, financially, figuring out how much I want to risk, what I want to do ahead of time is very important. And it also makes it a heck of a lot easier to trade, all right, when you know what you want to do out of the gate, all right? And it makes it so it's not so stressful for you. You wait for it, you watch the setup, and then you take it, and then you get it out when it goes to the target. Now, this was the other day. This was a short. This was CVS. Let's look at the chart. Stock had a rally. Here is a gap. Just so you know, this is a gap up. Now, what is a gap? I'm just going to give you a very basic definition of what a gap is. A gap is a difference between the close and the open. So CVS closed here the night before around 67.50. Boom. Gapped up here to 69.50. This was back in early November. So this was a gap up. Then it rallied. There also are gap downs, okay? What is a gap down? This is a gap down over here. This is a trade we're going to review from a couple days ago. This is the drop here on the 10th. This is a gap down. Stock closed here, open here, dropped. This is a bearish gap. This is a bullish gap, okay? So anyway, CVS on this particular day here was a short. On this day it was a long. On this day it was a short. Here was the 10th. So here's what it did. This was a massive sell-off that happened. And you can see the time of the day here. This is a 1 minute. So that was the daily. This is a 1 minute chart. For those of you that aren't familiar, again, with me, I make trade decisions based purely on technical analysis on gaps. So it's technical analysis. I do charting. I'm a chartist. I read price. That's what I talk about even on Fox, okay? So CVS here had a massive sell-off, very big, very fast, very quick into the open. This was on December 10th. I forget the reason. I think it was news or something like that. You can Google it. Anyways, it was real. So here it was, boom, fell off a cliff, okay? Then it rallied, boom, we shorted it. Got the drop, shorted a little bit more, did an add, got the drop. So you could have got out right away here at 10:15. You could have held it here into noon. You could have held it even a little bit more, okay? This worked, no matter where you got out of it. It was a really, really nice short. And if you happen to even catch this, you could have even gotten that, all right? But here was the entry that I called in the day trading room. Entry was 73.50, 7,000 shares, which is an advanced risk, okay? Stop was 73.75. This was an amazing stop for this stock. To get a 25-cent stop in CVS at something at this price point is really, really, really good. You literally could have taken 1,000 shares in this and only risked $250, and it was a beautiful trade. Then we added, okay, when I saw that it was going to keep going, we took more, okay, at 73.10, doubled the position, 14,000 shares, dropped, fell, exit was 72.85. I think the low of the day ended up being 72.60, 465-ish, but this was $6,300 profit, boom, boom. I'm going to go back and show you. Here it is again. And again, you could have done this. So this was a bearish gap in CVS that we shorted on the 10th. Got it? Boom. Took a little bit more. Got the drop. Based out. Got the drop. okay? So really nice sell-off here in CVS, really nice move, nice gap that just kind of fell off a cliff here and then followed through. Again, as a day trade, you're looking to day trade it, you're getting in and you're getting out, you're getting in and you're getting out, okay? So it was one trade, one day of work, and one strategy that I utilized to find that trade and do that trade. So it makes it so much easier when you are, it's like if you went to a job, whatever your job is, say you have a job, and you are in charge of this machine. Say you go to a factory, you are just in charge of that machine. You're on that machine every day. You have to do the same thing. Boom, boom, boom. That's what I do. I'm looking for the same thing every day. Do. Monday, Tuesday, Wednesday, Thursday, Friday. I don't know which stock I'm going to see it in, but I know I'm looking for the same thing, for the same thing, for the same thing, just like a computer, okay? Like if you were going into a factory and a machine. And if you look at it like that, it really makes trading so much easier for you. Because if I see what I want, then I do it. And if I don't see what I want, then I don't do anything at all, okay? Any questions? And again, it goes back to what I was saying about the consistency. Okay. Any questions here at all? Let me see if there is any. Trying to. Okay. Quiet group here today. I'm just going to keep talking. I don't see any questions unless I'm looking at this jiggy wrong. I don't think there is any. If I'm missing anybody's questions, they'll let me know. All right, now let's talk about Starbucks, which was today's trade. Again, this was a bullish gap up. Really nice move in the Starbucks. Went to the target on the day, which was 89. Again, nice gap up. This was an upgrade. Starbucks closed here, gapped up. Boom. Dropped, rallied. We went long in here, rallied up, faced out, took it out. So again, this ended up going all the way up to 89, but this was a beautiful move. We had a perfect entry in here, rallied, okay? Again, time of the day. Looking for that time of the day, that concrete time of the day when I'm looking to get in and get out, and I'm looking for the momentum. Here was the Starbucks over here. Here is the gap up, okay? This closed here, this gapped up, all right? And here you have the little Starbucks. So a very nice chart. Starbucks is in an uptrend, okay? And just had a beautiful entry in it today, right out of the gate. Entry was 87.80, 6,000 shares is an advanced trader risk. Stop was 87.40. And when I'm in the trading room, I'm calling the entry, calling the stop, calling the entry, calling the stop, calling the exit, calling the targets, live in the room, okay? And if you want to trial for the trading room, you can email me today and you can be in the room tomorrow morning. There's a lot of earnings out tonight. I don't know what we're going to be doing tomorrow, but there's a lot of things to be looking at. Adobe's tonight, Costco's tonight. I don't know how they're going to gap, but there's quite a few things to look at tonight. Anyways, profit on this today was $5,280. A beautiful, beautiful, beautiful move. This kept going, like I said, went all the way up to 89. Nice move, almost a buck in Starbucks. Again, you're in, you're out. Time of the day, let me go back. Again, right into 10 o'clock, right into 10 o'clock. So again, this is a gap up. Here's where it closed. Here's where it opened. So what do? In the morning, in the pre-market, I rate the gap in Starbucks. I rate it based on the daily chart though. I don't know if it's going to gap up or down, but I see the gap. In this case here, this was a gap up. In the case of CVS, it was a gap down. I see the gap and then I rate it. I rate it using a 26-point rating system. That system tells me if in fact this is going to move higher or if in fact it is going to move lower. And then I make the choice to do the trade as a long or short based on the rating system. And that's what you come and learn from me. If you wanted to take my class and learn my strategy, you learn the rating system. How do I know that Starbucks was the one to do today? How do I know it was a long? Well, because I rated it. I rated it in the pre-market. And again, sometimes things gap at night, like Costco and Adobe are tonight. and you could rate them if you knew my system in the after hours tonight, but I usually wait and do it in the morning. Sometimes things can change. They can change to be better. They can change to be worse, okay? Any questions? And one more thing that I was going to say here as well, in reference to the market and volatility that we've been talking about right now, okay, in this environment in 2019, and even more so going into 2020, okay, going into 2020, when I'm looking to do things specifically every day, okay, and many things we do are shorts, but I will go long. Like today we did the longs. It's really important to make sure that what you're doing really doesn't need the market. You will have more consistency if you don't need the market, because in this environment, again, 2019 going into 2020 with the election year coming up, expect volatility in the market to swing around. So if you're waiting till after 10 o'clock, or you're waiting to determine the trend of the market for the day to get your trade, 9 times out of 10, you're going to be wrong, all right, whatever you think it's going to be. Today's a good example because of the reversal, but also you don't want to have to rely on the market. The market is challenging to read, and I get it right a lot, but even I don't get it right every time. You want to do specific stocks, specific moves, specific things that are going to move that do not need the market, and especially going into 2020. Again, if you want to stay consistent. Just trend trading stocks in their trend, whether they're up or down, is not going to see this level of consistency because the market affects things on any given day. Stocks that I'm doing are gapping for specific reasons, and then I'm rating them for specific criteria that I'm looking for each day. And that's what's telling me, A, it's going to get bought, or B, it's going to sell off, which is important. Because if you need the market, you're going to get beat up, and you may have been getting beat up this year because a lot of people didn't think the market was even going to keep going higher. And then it did, and then even today, the rally that we have, and then the sell-off afterwards today. So, I mean, you know, it just proves my point. Going into the election year, you've really, really got to know what you're doing to trade, get the right stocks, get the right picks, and not have to rely on the market, okay? Any other questions? I'm trying to think if there's something else I was going to say on that. Okay. All right, so again, getting back to day trading. If you're looking to day trade, people always say, well, what percentage? This isn't long-term investing. Day trading is you're in, you're out. You're in between 9:30 and you're out before 4 o'clock. And returns can be incredible when you think about it based on percentages, okay? You trade on margin if you're day trading. You do not need the cash value of something like Starbucks at 88 bucks a share or whatever you took it at today in order to make the money. Otherwise, you would need hundreds of thousands of dollars to trade. There's something called margin. Every day trader trades with margin. It depends what broker you trade at, and if it's a prop place or retail place, how much margin you get. The options, you're not trading on margin. You're trading the cash account. So it's different. You're trading the cost of the option. You're just paying it. But the point is, the idea of the returns are incredible because you are trading on margin, and they can be crazy high. So I look at it like it's called a risk amount of a risk of return that I'm looking for. Like if I look 1-to-1. If you're risking 1,000, you're looking to make 1,000. If you're risking 2,000, your goal is to make 2,000. Sometimes you will make more. Like today is a good example because the stop in Starbucks was really a very nice stop, a 40-cent stop, and a price point of that stock is amazing. Okay, great entry in that today. So the risk to reward today was higher than 1-to-1, all right? But this is not investing. It's you're in and you're out, you're in and you're out, okay? Make sense? Any questions here so far? So when you start to get into this and you really start to make money and you really start to do well, again, you're going up the ladder. Even if you're going up and you take 10 steps up and 2 steps back and 3 steps up and 1 step back, you're building your conviction all the time. It doesn't mean you're never going to make a mistake. It means you're learning and you're building your accounting. You're making money along the way and you're learning, you're gaining the knowledge, and you're gaining something I call conviction. Conviction is something that's very important to me, and it's something that I use to make the calls, to train, to maybe hold something, hold something to a bigger target. Or maybe I don't have conviction in something. Maybe I lack conviction in something, and therefore then I don't do the trade at all, okay? So for what I'm looking at though in the gaps, and again, when I'm looking to do them, and Starbucks, I'm going to use an example because that was today's trade. I'm looking for, in the case of Starbucks, I'm looking for institutions that are buying the stock. So I'm saying, okay, are institutions going to buy this stock, institutional money? And if I see that's going to happen, then I will go long it. And the rating system tells me that, okay? So when I'm looking to short something, like the CVS, I'm looking for institutional selling or institutional shorting, okay? And I say, okay, the stock is being sold off by institutions. Therefore, I want to get in it short. When you go with institutional money, it's going to be a lot easier for you to make money, and especially quickly, because institutions move stocks. So like there are tons of funds in the market, small funds, big funds, hedge funds of all kinds of different sizes. They're taking positions in 50,000 share lots, okay? They will move stocks when they take a position, maybe a little, maybe a lot. All the stocks that I'm trading are stocks that you would know of, companies, Peloton, Amazon, Apple, things that you know of, CVS, okay? They're not penny stocks. They're not junk stocks. They're not crap. They're not low float stocks that don't have any volume on any normal given day, that are not traded by institutional money. We're trading stocks that move, where you're a blip on the radar, and all you need is a couple thousand shares and you can make a lot of money because there's millions of shares in them and they're being traded by institutions, and that's who's moving the stock. That's who's moving the market too, by the way. Institutions are moving the market, not day traders, not retail traders, okay? Any questions? So it makes it so much easier to profit when you're with the big movers, when you're with the big money. And that is what my rating system, that is what the system that I use in the pre-market directs me towards. It helps me predict that this is going to happen on the day. So this morning I predicted that Starbucks would go to 89. I knew it would go to 89 today, all right? And that's what it did. So it predicts it in the pre-market based on the gap. I'm not predicting the gap itself. Like I didn't know last night that Starbucks would gap up this morning. I had no idea. I don't know what Costco's going to do tonight. I don't know if Costco's going to gap up or Costco's going to gap down. I'm not in any trades in Costco. I may not do Costco at all, but I'm going to watch it. I'm going to watch it. I'm going to see where it gaps, and then we'll take a trade based on that. Follow me? Any questions? Let me know. Any questions from anyone about anything at all so far? All right, let's look at the market here. So the QQQs, here was the pop. So again, let's go over one more time here what a gap is. Market gapped up here, closed here, gapped up. I called some calls this day. This was a nice move up in the market, rallied. Boom, 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 dropped. Here was a gap down in the market, fell. Here was a gap up, rallied. Here was a gap up, dropped. And then here was the move over the high today. So the market right now, I'm talking about the market, I'm saying the market, but the QQQ's ETF is strong, 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 strong. So if you're in something short to the downside right now, it has to be super weak on its own, super duper weak, okay? And also right now, going into the holiday season, you have to be careful about holding too long. I wouldn't hold any trades too long overnight at anything here between now and the end of the year. But day trading is not investing. You shouldn't hold trades too long at all, even if you're doing options that are working a day or two, all right? It's a way of producing income, not investing. You're taking money out of the market daily in fast moves. And one of the things that most day traders forget or just don't understand is that this is not investing. You're chunking it out. You're in, you're out, you're in, you're out, you're chunking it, okay? And this CVS, again, is another great example of institutional money, because in this case here, again, Starbucks was institutional money that bought the stock today. CVS was institutional selling. Institutional selling, look at the move. How could a stock at this price point fall off a cliff? CVS is up here at 75. What is this down in here where it dropped and fell off a cliff? 72.60. So CVS, a $75 price point stock, dropped and opened and fell $2.40 right out of the gate in the first 5 to 10 minutes of the day. That's a dump. It's selling action, okay? And you can make money as a trader by shorting the selling action that's coming in from the institution selling. Again, who knows why they sold their CVS, but they did. Make sense? And so you're getting in and you're shorting that. But most of the trades that we're in and out are less than 30 minutes. Sometimes I'll hold something an hour. This is, again, the day trades, not the options trades. But every once in a blue moon, I'll hold something a little bit longer, bigger move. But I'm always trying to get in the first half an hour. Okay? Any questions by anyone at all here so far today? Really quiet group here today. I don't see any questions at all. Does anyone have any questions of me? Or am I just, everyone's mesmerized by everything I'm saying, taking it all in like a sponge? You're all sponges today with me talking. Well, hopefully you're learning something. Anyways, what I do is just focus on one strategy, usually one pick a day, maybe more than one. And again, I'm in and I'm out, and I'm looking for the volatility, and I'm looking for the move. I'm looking for institutional selling or institutional buying, okay? That is really what I'm focused on. So for me, okay, this is really what I'm looking for is to just chunk it out every day. One amount of whatever I'm risking, okay? And it could be a different ticker symbol every single day. Every single day it could be a different ticker symbol. I never know, okay? Like I said, there's a bunch of things out tonight. I don't know exactly what I'm going to do. I know I'm going to do something tonight because there's so many earnings out, but I don't know what, okay? Okay, now I'm seeing some questions. How do I spot what? Were you talking about a specific stock? I see the gap in the pre-market or the post-market. Okay, like for example, Costco is going to gap tonight. It has earnings. It's going to move. I don't know if it moves up or it's going to move down, but I will see it in the after hours tonight. After 4 o'clock, you can watch Costco. Then I will rate it per my system. And then I rate it determining our institution is going to come in and buy it tomorrow on the day, which is the day that I'm going to play it, because I'm not playing in the after hours. You can't do options after hours, and I'm not doing equity trades after hours because it's too risky. Okay. Equity trades during the day, when I do them, I put the stop in. Like CVS had a stop. If CVS had dropped below where I had the stop at 87.40, would have been stopped out and I would have lost. That did not happen, but I had the stop in. The stop is like the insurance. It's like the protection. And I don't use stops for options because it's just whatever I risk. So that's it. That's the stop. The stop is the risk, okay, and the option for me. I have a rating system, yes. The rating system tells me if the stock's gonna get bought on the day, if the stock's gonna sell off on the day. And that's how I know whether to go long or short it, okay? Now let's go over BA. BA was a nice short. I called the 350 puts back on Monday, around lunch, actually. I called this a little bit late on the day. And this stock had a beautiful, beautiful move down and continued down and then gapped down. I'm gonna show you the chart on this here. So back in the day here, this is the night. I called this. Then guess what? It gapped down the following day, fell. You could have actually gotten out of the trade here. And then the next day it gapped down even more. So the nice thing about doing the overnights when I call the options trades, I have an options newsletter, is sometimes they will gap into the move. Like I'll call them and you'll get up the next morning and you'll be up in the morning and you'll be in the trade and you won't know how much you're up until you get up. And then you say, oh my gosh, I'm up a lot. Sometimes it'll gap into it. And that's what happened here. This was a nice put, okay? So I'm showing you 3 risk amounts here, depending on where you're at, again, the size of your account. This is for an option trade. There was an option call from the options newsletter, okay? An advanced risk on that would be $7,000. Cost of the option was $350, exit 11, would have been a $15,000 profit from Monday to yesterday. A really, 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 really nice trade. Beautiful trade, beautiful return on investment within 48 hours. If you had an intermediate trader risk, 10 contracts is $3,500 risk, you still could have doubled your money and made $7,500. Again, really, really, really nice trade. 200% return on an investment within 48 hours. Beginner risk, $3.50, 2 contracts, $700 risk, $1,500 profit. Again, boom, 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 okay? And this went into the move, dropped into the move. So I predicted on the 9th that this stock would continue having institutional selling. I was right. Boom, boom, boom. And in fact, I called it, let me go back to the trade call here, to expire tomorrow. So I knew this would happen this week. Sometimes I give a little bit more time, but I didn't think it needed it, okay? And I was right. Very, 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 very nice short. That was in BA. So that was, this is an option trade. I'm showing you again, same system, same philosophy, same strategy. A different way to take the trade is an option instead of an equity trade, but still pretty quick, okay? But again, you're protected in an option because the most you can ever lose if the trade fails is whatever you paid. So if you paid $3.50, you won't lose any more than that, all right? So I'm calling calls, straight calls, and straight puts on the options letter. But if you want to day trade actively, you have to look at the size in your trade, 1,000 shares, 2,000 shares. Again, set your goals. If you want to make a certain amount of money, 6 figures a year, whatever you want to make, you have to back it out. You say, okay, well, if I want to make $1,000 a day, then I got to get $1 move in something, or I'm going to get 50 cents in something to take 2,000 shares. You have to figure it out to back it out like that. But you have to have the money to take it, okay, like I'm saying. But the reality is you can say, okay, it's January 1, I'm going to do this. And then by March 1st, I'm going to do this. Then March to, May, and you track it out so that you're always moving up. The goalpost is moving, okay, so that you're getting somewhere with this. It doesn't mean that you're never going to make a mistake. You will have to learn along the way. Let me see, there's a question. I'm doing day trades as equity trades, straight out equity trades. As far as options trades, sometimes I will day trade options trades. Sometimes I'll hold them overnight. So I'm doing them out for the week or 2 weeks, but I'm not day trading options every day. Some days I hold them. BA was a hold. Some days I will get out of them the day. Some days I won't. If the stock makes a move in the day, why wouldn't I get out of it? Even if, and this is where people just, oh gosh, listen, people, listen up. Your goal is to make money. Your goal is to make money consistently. That's how I started the talk today. If I had $1 for every story of a person that told me that they held something too long, in this market, you're going to get killed if you hold things too long. If you risk $1,000, you're up $1,000. Even if the trade has 3 more weeks to go, you really want to hold it? Really? What if you risk 1,000 and you're up 2,000 and the trade still has another week to go? You really want to hold it? Why? Tomorrow you can take another trade. I'm calling so many trades. When you look at all my equity trades and my options trades, I'm calling plenty of trades for people to make so much money. It doesn't matter. You don't have to hold these things. Again, this is the investor mentality. I never grew up with that. I never grew up with that. I didn't know anything about trading when I started. I never had an investor mentality. I never had a buy and hold mentality. I never did. So that's probably why I'm do really well at being active. But so many people have this buy and hold thing. And even if it's short and hold, this hold, like you're holding on to it for dear life. I had this one trader, he said, oh, it looks really good. But the chart looks really good. The chart looks really good. The chart looks good. Yeah, the chart looks good until Trump tweets and there isn't a China deal and everything falls off the planet. Do you know what I'm saying? I mean, I just got done talking about volatility. Trading is making money. You're not Warren Buffett. You cannot suffer to hold things and lose money in trades that are up, because you will lose in trades that don't work. Do not lose in trades that are up. Do you understand? I mean, that's just being like smart. And people make that mistake all the time. And I only have a few more minutes here. I know I started late. Somebody said, I don't know what point you were trying to make about the double-edged sword. You lost me there. Yeah, a lot of places don't have commissions now. That's true. Anyways, focus on the time of the day. Focus on that, about buying options, doing them. Again, getting back to what I was saying here. If you want to do this for yourself, if you want to work for yourself, you can do it. You must be focused. You must book money. You must take profits out when you're up. The nice thing about trading, whether you're doing options or equities, is you can do it from home. You can do it from home. but you must be realistic. So many people, and I hear this all the time in marketing emails, well, you can take $500, make 100 grand in 3 months. Really? Seriously, come on. I mean, I think you got to be realistic. You risk $500, you're looking to make 500. You do it Monday, you do it Tuesday, you do it Wednesday, you do it Thursday, you do it Friday. By the end of the week, you should have between $2,000 and $2,500. It's the consistency, and it's the consistency in the strategy. And I don't trade any stocks that I don't like that don't rate per my system. What if they go into work and I don't do them? Well, then they go into work without me. If I rated it and it didn't rate well and it still works anyways, I don't feel like I missed out. I didn't lose any money. I didn't make any money. I probably did something else that day that worked that did rate well. Because 9 times out of 10, there's usually things that rate well. Okay. And again, there's a lot of stuff to look at tonight for tomorrow. Okay. Anyways, risking money can be hard, but it's the idea of learning. Once you learn and you have the confidence in yourself and the strategy, then you can put the cash on. You can put the risk on. When you say, I have 100% conviction that BA is going to drop, I can risk $7,000 to make 15. Do you understand? But when you don't know what to do and you're so new and you don't understand what's going on, and you don't understand the system, that's why you have to take the class. Everyone has to take the class to be in my live trading room. All right. It's a prerequisite to do it. And that's because people really have to know what to do in order to be successful, in my mind. But your dreams are totally achievable with hard work. And I believe that it becomes easier over time. You're chunking out money every single day. Okay. Any questions here so far? If this is you and you've been losing money for the last several years, say you lost 50 grand for the last 5 years attempting to day trade, you must stop what you're doing. Whatever strategy you're doing is not working. You have to be honest with yourself. And I know this is a hard pill for people to swallow. People will go years and years and years and years and years and lose, and they can't swallow the pill. They will still drink the Kool-Aid, that they can figure out how to do it on their own, and that they don't need any help, and they don't have to pay for a class, and they're gonna make it, and what they're doing is working, and all they have to do is buy into 50-period moving average. No, okay? All along the while, this person was making money every time this went up, but then he lost more. Then he made a little money, then he lost more. Then he made a little money, then he lost more, but over the course of years, he's losing. This is problematic. It really starts to drain on you as the time goes on. The best thing you could do for yourself to turn things around is recognize that you, in fact, do not know what you're doing if you're not making money by the end of the calendar year. We're come December. If you didn't make money this year, then your strategy you're using does not work. So you have 2 choices. 1, pay someone that's an expert in the market like me to learn my system, what I know, or follow my trades. Or 2, stop trading and quit. And don't do it anymore, because you're going to bleed money into 2020 if you continue to trade and go down this path. And eventually, it just takes a toll on people. It takes a toll on their confidence and their finances. The best thing you can do is to get honest with yourself and look at yourself in the mirror. This doesn't mean you're a failure. If what you've been doing has not been working, it doesn't mean you personally are a failure. It means the strategy that you're doing to trade, that you're using, is a failed strategy. Do you understand? So many people think, well, I have to accept then that I failed if I quit. I have to accept that I failed if I have to pay someone like Melissa to learn her system. That's not true. It took me 3 years to figure out how to do my system, 3 years to put it all together. It was like a lifetime for me because it was a very difficult period in my life, but I figured it out. I think I'm an anomaly. I think I'm an unusual person to have done that. I'm an extremely strong individual. I don't think a lot of people have the money or the time or the wherewithal, the strength of character to do it. So you pay someone, and that makes the process easier for you. But I found that through the years, talking to people and having people follow me and come to free webinars like this, they just don't want to, they don't want to come to Jesus moment. They don't want to say that what they're doing is not working, because somehow that would make them feel like a failure. In the end, you're not a failure if you say the strategy that I've been doing doesn't work. Shorting tops and buying bottoms doesn't work. And if you admit that doesn't work, you'll stop losing money, number 1. And number 2, you'll turn things around. And I think 2020 is a year for fresh starts, a year for people to turn things around, a year for people to really make the most out of their life. I think it's a turning point. Numbers wise, all of it, everything together. And I know I'm running out of time, so I'm just going to quickly go to the strategy and the class information here if you're interested. I teach a system. It's called the Golden Gap System. It's one strategy. That's all you need to be successful in the market. You do not need a general overall broad-based view to make money. Tons of people have that and fail all the time. Learn how to read institutional money and price patterns and gaps. It's something that I teach in my class, and you don't need to do anything else. Okay, it's what got me on TV because I'm so good at it. Because if your reason for doing this is to make money, you will make money if you follow a system. You can do this from home. And the class, if you're interested, is this weekend. Now, I know today is Thursday. This is the last class of the year, though, because of the holiday. It's December 14th and 15th, 9 to 5 Eastern Time. Class is online. You can be anywhere in the world and take it. Cost of the class is $64.99, okay? Email me if you want to sign up at melissa@thestockswoosh.com. The combo includes the trends. It's 2 classes for $69.99. So you take the class Saturday, Sunday, and Tuesday. This is 11 to 2 on Tuesday, and you would save, okay? 2 classes for 1 price. If you cannot do the class in December, the January class is January 11th to 12th, 9 to 5. Cost of the class is $64.99, okay? If you can't do the class this weekend. I am doing a holiday deal, though, through Saturday. If you want to do the class this weekend, you'd have to sign up by tomorrow. If you want to do the class in January, you have through this Sunday to sign up for this offer. You would get the trading room free for 1 year, 1 year with the class. You just have to sign up and pay by Sunday. But if you want to do the class this weekend, you'd have to sign up and pay by tomorrow. If you want to do the class in January, you could sign up and pay Sunday, the 15th of December, this weekend, and then start the trading room in January. Normally, I charge $4,000 a year for the room after the class. So this is a really, really nice deal. But trust me, you're doing yourself a favor. You will save money in the long run if you get proper education on a right system. And if you're losing, that what your system is doing doesn't work. If you're interested in only in options, then I have an options newsletter. It's $59.99. It's 1 year. I only have an annual membership. The trades are emailed to you. You get the trades. BA was one of them this week. There was a ton this week, actually, but I just talked about the one.
I'm gonna take a quick detour. This is a short presentation, thankfully, but we're going to take a look at the markets really quick for those of you that are paying attention. I just want to lay out my thesis. I'm sure that, you know, we talk about some high level concepts, and we'll get to that in a second. I just want to show you what's going on in the market right now. So there's been an overhang in this market for a couple weeks now, where the market was hanging right at all-time highs, but the VIX was above 15, and we finally got a headline. We had the Fed yesterday. We've got some British election stuff today. But the main thing was the trade deadline. There was actually a tariff deadline on December 15th. They floated out the idea that the tariffs may be cut a little bit, or at least the can will be kicked down the road, and that's why we saw such a strong spike. The main thing I'm looking at right now is 3150 on the S&P cash. That coincides with the levels from 6th of December as well as the 27th of November, that melt up that it had the day before Thanksgiving. Right now, the market has faded into that level. If we can hold that, then we should continue to see follow through. If we cannot hold that, if 3150 does not hold, then we'll probably start to see a failed breakdown. One of the reasons that I was bullish headed into this event is given the fact that the VIX continued to stay above 15, even though we're headed into the end of the year, which tends to be a little bit more quiet. And we also had the VIVIX, which is another indicator that I watch, where we had continued higher highs and higher lows, indicating that there was demand for hedging in VIX options. So all of that means everyone and their mother was overhedged and scared of this event. And when you have enough people overhedged and scared into an event, it leads to a lack of follow through to the downside. And that's one of the reasons I think that we popped, and why it's going to be so stinking difficult for this market to sell off over the next few weeks, which leads me into our discussion about buying the dip, because the market is hitting all-time highs. And if you weren't loaded up to the teeth into this move today and you didn't take profits, you may be feeling a little bit frustrated. You may be feeling like the train has left the station, and you either are going to get stubborn and revenge trade and try and short this market, or we're going to look at some strategies and tactics that you can use to say, you know what, I'm going to be patient here. I'm going to wait for my setups to come when they do come. And we're going to identify places in which it makes sense to buy the dip, some psychological things that you can consider when you're buying the dip, and some option strategies to consider as well. So I'm going to pull up the questions and answers tab really quick, just to make sure I can see, because we will be looking for some feedback on this. Standard disclaimer applies. Options trading can change your life. Whether it changes it for the better or worse is going to be up to you. How you manage your risk, how you position size, the option strategies you choose, and your own psychological profile. Options trading, just like Forex, futures, Bitcoin, tulip bulbs, whatever financial speculation you do, you got the potential to blow out your account. So you got to make sure that you size appropriately so you don't blow out your account. For those of you that don't know me, my name is Stephen Place. I'm the founder and head trader at investingwithoptions.com, and I help folks just like you realize their financial dreams through options trading. I am an options trader first, an educator second. I am a believer that you must find your own way in the options market and identify the style that works for you. I tend to be 80% on the option selling side of things. I will be a net option buyer when the opportunity strikes. Yet I believe that there are ways to generate sustainable income to build aggressive wealth in this market and use compounding in your favor. So let's talk about dip buying for a second. The first thing is, this is what dip buying looks like on paper. This is the idealized setup, the thing that you see in textbooks and so on, where you find a price level. Let me see if I can get drawing or pointer. There we go. You find a price level on a stock, and in this particular example, we're looking at Lululemon, where you see a pullback to the 50-day moving average, a hammer candlestick gets knocked out. The market fails to see follow through to the downside sub 190, and that's a good place to buy the dip. The ideal scenario here, you buy the dip and it immediately skyrockets up, right? That happens every once in a while, but it's rarely that clean. Here's what happens when you try and buy your first dip. And this is an example in, I think it's Home Depot, where you look for the pullback comes, you buy the dip, and then there's no bid in sight whatsoever. The market just continues to go down and down and down until you get blown out of your position or your options expire worthless, and then that's when the market reverses. Okay, and then what happens here in this painful cycle of dip buying is that you say, okay, I'm done with the dip buying, so I'm going to just avoid the next time we see a dip. And this is an example in Apple where you get one or two small dips. If you avoid them, the stock just skyrockets higher without you on board for nice profits, and it just leaves you feeling very, very frustrated. What are some solutions that we can think of? We know our problems here. We know that it can be, it can be very difficult to have the right kind of psychology to dip buy, because what will happen is that the market will be up and you say, oh, I can't wait for the next dip. All right, so I can realign my positions with the overall primary trend in the market, and once I get that dip, I will put risk on the table, right? But as soon as that dip happens, you think it's the end of Western capitalism, right? And then you say, okay, we're down 3% on the market from all-time highs. I was going to buy the dip, but now I'm going to wait for a 10% drop because it looks like death, and the market's just going to absolutely fall apart. All right, that's the rinse and repeat cycle that we've seen in this market for years. Okay, and then once everyone does buy that dip, once everybody loads up on that dip, that's when the market absolutely falls apart. Okay, dip buying, in my opinion, is primarily a psychological problem. All right, if you follow some trade alerts and you look at textbooks, your brain does not act the same looking at trade setups in hindsight and looking at potential setups and using whatever technical indicators you're using, because there is a difference. Excuse me, I'm coming back from a cold. All right, so you just have to bear with me while I cough a little bit. There is a difference between analyzing a setup after it's already happened and actually putting risk on in the market with the potential for financial loss. Because as soon as you do that, there is a part of your brain called the amygdala. It's also known as your lizard brain. This part of your brain cannot tell the difference between the potential to lose a couple $100, couple $1,000 and a saber-toothed tiger about to eat you. All right, your brain cannot tell the difference. And so the avoidance of that physical pain that you feel with the potential for financial losses is one of the reasons that you avoid good setups in the market. One thing to keep in mind here is that the amount of money available every single day in the markets is awe-inspiring. All right, you need to pivot from a scarcity mindset to an abundance mindset. Imagine that you just took the year off from even looking at the stock market. When you get back a year later, do you think there are going to be opportunities in the market? Of course there are, right? There's always going to be opportunities. So even if you do miss a move, you need to look for ways to get involved again. Here's a useful exercise, and I've done this a couple times, where we look at buying two different kinds of stocks, where you buy a stock at 20 bucks and then you sell the stock at 30. That's trade scenario number one. And let's say trade number two, you buy the stock at 50 and then you sell the stock at 60. Now I want to ask you, which one is going to be a better trade? Now you can use the Q&A box to give me an answer, just to make sure that everyone out here is alive. I know that there's going to be a bit of a delay, and I also want to use this to make sure that we do have live responses in the Q&A box. So which one do you think is better, trade one or trade two? And I'm going to go ahead and tell you that yes, this is a trick question. And I'm going to multitask a little bit because I want to see if the market is holding 3150. It is. We bounced right off 315.5 on the SPY and 3152 on the S&P cash. All right. So we're seeing some people come in saying trade one percentage is higher. You get a better return on capital on trade one. Here's the thing, because I know it looks like on a percentage basis better, right? Because you buy the stock at 20, you sell it at 30. That means you get a gain of 10. That's 50% return, right? You buy this trade number two, you buy the stock at 50, sell it at 60. That's $10 gain. That's 25% return. I don't pay my mortgage on basis points. I don't pay my mortgage on percentage points. All right. We're not looking at percentages. We shouldn't look at percentages. We should instead look at absolute dollar values. $10 gain is a $10 gain. Now I know that it is a trick question. You're probably going to go into the Q&A box and say, well, technically, I view risk in the market in terms of R multiples. So if I'm risking, let's just say $2 and then I make $10, that's a 5R trade. It doesn't matter where the stock is trading. Okay, and this is important. This is good conditioning. This is a great psychological exercise for you, because what will happen here, and I'll just pull up some charts as an example. All right, so here's a chart of Apple, right? There are plenty of opportunities in this stock, no matter if it's trading at $150 or $250. All right, this is important, because what I see a lot of my clients do is they say, crap, I missed the move. That means I'm going to completely eliminate it from my watch list and avoid any kind of further profit opportunities in this stock. It's a very dangerous thing in terms of opportunity costs. There are going to be plenty of trading opportunities, especially in these high beta, large cap stocks. Now with me, I'm an options trader, which means I have to focus on liquidity. I don't need to find the next Amazon or the next Apple. I can trade these stocks over and over and over again and get much better returns than if I were trying to pick stocks looking for the next 10x trade. All right, I can make 10x on an investment by using the natural volatility of an individual stock, no matter where it's trading. So this exercise for me is being price agnostic. All right, I don't care where the stock is right now, because my view and my expectation is going to be 1 week to 1 month out. I don't care if a stock is going up 10x. I just care about the trade right in front of me. There are a lot of investors, for example, who completely missed the boat on Apple in 2013. And then they said, okay, I'm not going to trade Apple. I'm not even going to look at Apple anymore because there's no profit opportunities anymore. Well, post split back in 2013, where was Apple trading? Right? 75, $100. And here's a chart. Here is a listing of all of the major corrections we've seen in Apple over the past 10 years. In 2012, we saw it get cut in half. In 2015, we saw it get cut in third. In 2018, we saw that crash where the stock got cut by almost 40%. There's always going to be these opportunities in these stocks. Okay. So one thing that you can get out of this is to condition yourself to look for all of these opportunities in the market and not be too worried about missing the boat, because the boat is always going to be there. So we're going to take a look at 3 case studies, and these are actually all in the same stock. This is in Lululemon. So a couple years ago, maybe a year or two ago, Lulu was trading at $80 a share, right? It had gone sideways for a while, pulled back into the rising 50-day moving average. I thought that this was a good price opportunity. I like to use credit spreads. So this is an example of a credit spread. All right, this sell to open, the April 70.65 bull put spread at 70 cents, which means for every spread you put on, you receive a credit of $70. Now, I don't, for other reasons outside of the scope of what we're talking about today, I don't like to hold on to sold options all the way to expiration. That tempts the market gods, and they will say, if you don't think it's going to be there into OPEX, we're going to show you how it's going to be there. I'd rather close out early. So my plan is to scale in, scale out, where I could get $50 per spread. Now, $50 may not seem like a lot. Well, you're only doing it on $430 of leverage on margin. If you do 10 of these, you get $500. If you do 20 of these, you get $1,000. All right, that's the kind of risk reward that is amazing to use with these kinds of strategies. All right, so this trade worked out very well. Fast forward a year. All right, so this was recently. This was another kind of trade setup. It's the one we talked about, that perfect dip buy setup where the stock auctioned lower post earnings. It found a 50-day moving average. It put in a hammer candlestick and it started to auction higher. Well, let's trade setup here. Same kind of idea. Sell to open the November 180-175 put spread at 90 cents. Now, last time we looked at this, Lulu was trading at $80. Now it's trading at 180. Does that make it a bad risk reward trade? Probably not, right? Because we're not looking at where the stock was a year ago. We're not looking at valuations. We're just trading the volatility of the stock. This is where a lot of people get hung up, because here's what happens, right? You miss the boat and you get angry that you missed the boat. And instead of looking for other profit opportunities, you go over to Zero Hedge, you read some bearish blogs, you start looking at the Case-Shiller price to earnings ratio and waiting for the next big generational bottom, because there is a concept known as disaster imprinting, where everyone thinks 2008 is going to happen again next month. And that kind of narrative gets pushed forth time and time again for the past 10 years. And what happens is that you miss out on some amazing opportunities. All right, there was a market crash recently, December, Nov-Dece 2018. The market pulled in 20%, right? There was no bid this time last year. It was wild, right? Apple got cut by 40% and there were no buyers in sight, right? A lot of funds got absolutely blown out. There were forced liquidations across the board and we crashed. There was a market crash last year and everyone's still looking for a market crash, completely forgetting that we actually saw one last year. Okay, here's another example. This is just 1 month later. Lulu's trading instead of it's trading around the same price, just slightly higher. We get another pullback opportunity into that rising 50-day moving average. So here's a trade setup. Sell the 170, 165 put spread at 74 cents, right? So the last trade, we were looking to pull 50 cents out, next trade 50 cents out, next trade 50 cents out. They're scaling in and scaling out, but if you do 3 of those, all of a sudden you're earning 150 per spread, all in the same stock at different prices. If you do 10 of these, it's $1,500 per spread, right? If you're scaling in, it's even more than that. All right, so as long as you're managing your risk properly and you're structuring your options trades properly, there is a potential to earn massive profits on the same kinds of stocks over and over and over again. All right. We know that there's psychological problems that we have to deal with. One of the things that you can do to eliminate those psychological problems is put systems in place to take your lizard brain completely out of the equation. So I use an upside down method. All right. I'm not looking for, when I look to dip buy stocks, I'm not looking for the weakest stocks in the market. I think that that's a very dangerous proposition. Instead, what I do is that I take my list, my favorite stocks that I like to trade, the very liquid ones, right? Apple, Baidu, Google, Facebook, Twitter, IBM, Netflix, and so on, right? The most liquid stocks in the market. And then I sort them by their RSI on a daily basis. An RSI is a relative strength index. It basically tells us how strong or how weak a stock is. It's a kind of an oscillator. And I rank these stocks and I say, which ones are the strongest in the market? This is my upside down method. And then all I do is I say, okay, where are good opportunities to put risk on in the stock on the first pullback? Because what tends to happen is stocks that are the strongest, when they have that first pullback, are good risk reward opportunities. It is very, very rare for a stock that is one of the strongest in the market to become one of the weakest all of a sudden. There are obviously some characteristics where we can look at parabolic shorts. That's a completely different setup. I call those Icarus stocks, stocks that fly too high, too far, too fast, and crash. All right, but in a normal market, absent earnings, absent any kind of structural risk, those are the stocks that I want to focus on. And that's how I focus on my trading system. I say, okay, what are the strongest stocks in the market right now? Where do I want to buy the dip? So let's take a look at a live example right now. JP Morgan is currently one of the strongest stocks in the market because reasons, right? There are several reasons for this. One of them is that we're seeing yields go down. So this is a look at treasuries on a weekly basis. But if we look at JP Morgan on a daily, it's moving strong. Honestly, if it pops a little bit further, I'll actually look to get short. But what I'm going to start looking at is saying, okay, where can I identify levels in which it makes sense to put risk on into any dip? And we'll take a look at some ideas in a second, but can you see how on the first dip, if that dip does eventually come, there is a tendency for buyers to show up again? Because on an institutional level, there's a lot of money floating around, right? And those institutions, what they will do is they will use maybe an analyst downgrade, or they'll basically pull the bid out of a stock, force a lot of stops to get run, and then they will buy the stock at a better price than what it currently is now. All right, so I don't have to buy JP Morgan at 138, right? I need to be patient and wait for the setup to come to me. In fact, I can start to plan my trade before it happens, and then I can actually automate my entries. We'll get to more on that in a second. Okay, so we plan our entries before your best prices hit. And you can use this, you can say, okay, let me find some key levels that I'm looking at, and I can set price alerts, or I can set good till cancel orders on spreads, which is a way to trade proactively, which completely eliminates your lizard brain out of the equation. So some support levels to look at. All of my analysis in stocks comes down to the idea of what I call a two-way auction. Okay, because stocks are an auction. And eBay is a one-way auction where you have a single seller and multiple buyers, potential buyers, but stocks are a two-way auction. We have supply and demand. So on the left side of the screen is the bid, and those are the participants of the market that are willing to buy at a specific price. And then you have supply on the right side, sellers that are willing to sell at specific prices, right? If there is more demand than supply, prices go up. If there's more supply than demand, prices go down. I am looking to identify levels when I buy the dip at prices in which I expect demand to exceed supply. It's that simple. If you're using any kind of technical indicators or any kind of trading system, there must be some form of anchoring around this idea, right? Whether you use a MACD, a slow stochastic, an RSI, moving averages, the idea is you're looking to identify price levels in which demand will exceed supply or supply will exceed demand. So support levels number one, I look for previous price support. So here's an example in MasterCard. MasterCard's already run away a little bit, but if it does manage to come back into 280, I'll look at that. But as you can tell over the past few months, anytime MasterCard has knifed sub 260, buyers have shown up, right? So if MasterCard pulls into 260, that's going to be a good place where demand should exceed supply, because the last time it was there were willing buyers. There were initiative buyers sub 260. Now, the more times a price level is tested, the higher the odds that we will see a failure, because eventually those buyers will run out. All right, but that's a good place to start. The next thing I like to use is previous price resistance. Oftentimes, these levels are retested and we will find willing buyers, because what happens? Just think about it from an auction idea. Think about it in terms of trading psychology. You have somebody on the sidelines who missed the breakout, and then they say, okay, if it comes back to that level, I want to buy it again. So here's a look at Nike. Nike sold off hard on news, something like their CEO was leaving, something like that. Excuse me. Nike pulled into 90, the rising 50-day moving average, and look at how well it held that level. There was a failure to see follow through to the downside, which was a good price opportunity. We're going to look at an automated trade here in just a second to show you how powerful this can be. Now, sometimes a stock moves so strong that there's no price history at all. We're seeing that right now with stocks like JP Morgan, where they're just jamming higher and higher and higher. So there's no previous price support or resistance that we can use. So one thing that we can use is major moving averages, right? I use the 20-day and the 50-day moving average for big price levels. Now, there's some things you can do in terms of aggression. I also like using the 8 and 13-day exponential moving averages, but those are a little bit more aggressive, and those are shorter time frame trades with weekly options and things like that. But using the 20-day, the first test of the 20-day after a major breakout is going to offer you good price support generally. All right, so here's an example of Apple recently. Apple broke out above 230. It pulled back right into that rising 20-day moving average. It's a little harder to see because it's a dark blue line, but that first test, and it went straight shot after that, right? And then it jammed higher up to 265 and change. Okay. One of the other things that I like to do with super strong stocks is a RSI. If we have an RSI above 70 or 80, and that shows us that we've been statistically overbought for a while, the first test of 60 to 50 on the RSI generally is a good place to initiate some risk, especially with bull put spreads. So here's an example of AMD. If AMD, in this particular example, back in NoVDs, it jammed all the way up to something like 85 on the RSI. If it pulls back to 60, then that's going to be a good opportunity. The reason it's a good idea to look at that is that the RSI will include time-based corrections rather than price-based corrections. And because these slides are a little bit older, this should give you a good example, because here it is live. Let me see if I can do this, where the RSI on AMD ran all the way up to 89. It pulled back to 60 just a couple days ago, and that is a good place to start outlaying some risk. Now, there was a pretty gnarly gap down last week. That also would have been a good opportunity into previous price resistance, as well as some major moving averages that aren't shown, but that gives you a good idea of how that can be used as sort of an extra guideline to say, okay, an individual stock, let's say a stock jams higher and then it goes sideways for a while, then you're not able to see good price opportunities in it because it did go sideways. I'm trying to think off the top of my head of something that did that recently. The only thing I can think of is Target, but it didn't give that true signal. But if Target goes sideways for a while instead of pulling back properly, then enough time has gone on where any sellers that needed to sell already sold, right? And any pull into that 60 to 50 area is going to be a good opportunity. Taz is saying, amazing trade on Target and Best Buy. I've got bull put spreads out late on Target into that first pullback. I can actually show you that in a second if we have time, but I think we've got about 10 minutes left. One other thing that you can use, and this is a custom indicator that I've built out, and this is more along the lines of structuring your options trades properly. This is the turning point indicator. This shows you how far and how fast the stock has moved over a certain time period. And then it also has these volatility bands that gives you an expectation of what kind of price movement we can expect. This is very useful for both overbought and oversold conditions. But what's more important here is that it allows you to pick option strikes if you are a net option seller to say, okay, the market has historically, let's just say, for example, AMD, right? The market has historically over a 25-day period sold off 10%, and that tends to be the floor. So if AMD sells off 5%, then you can go and look at selling some credit spreads 5% lower, and that can choose your strike price. Okay, that's why this particular indicator is so powerful. This indicator is available on Thinkorswim and TradingView. I think you can just look for it on TradingView and you should be able to find it there. One other thing that you can do is stack the odds in your favor with options. I'm a big fan, especially with newer traders who are still trying to find their way in the market, that you want to keep your risk low and you want to keep your odds high, and you don't want to put a lot of capital on the table. This is something that scales up very well. So instead of capturing a credit of $50, you do 10 of them, you capture a credit of $500, or you do 30 of them, you get $1,500 per spread. Okay, a bull put spread is pretty simple. It's an option spread where you short a put and then you buy a put that's a little further lower than the current price. All right, this is a high odds trade. It's a positive time decay trade, and it's a bullish trade. Okay, one of the reasons I like this, and one of the reasons I like aligning it with the strongest stocks in the market, is that there's a normal market cycle where a stock will mark up, go sideways, and go down, and then go sideways and then go up. That's the overall idea of how a market cycles. So when you do look to buy the dip on the strongest stocks in the market, even if you're wrong, odds are the stock just goes sideways for a while. And if a stock goes sideways and you sell credit spreads, that tends to be a profitable trade. It is very rare for a stock to go up and be one of the strongest in the market and then go straight down and crash after that. So you're further aligning the odds in your favor so you can become a consistently profitable trader. The next thing I really like to do is automate my entries. All right, so here's a case study in Nike. Again, Nike pulled back sub 90, right? It found some support. What I like to do here is automate my entries, and this is especially useful to remove your lizard brain from the equation, to really increase the odds in your favor and get a little trading psychology on your side. So this is an example. This is selling the Nike Dees 82.5 80 put spread, scaling in, scaling out. So initial trade is at 31 cents. Right, so you're picking up $31 on a margin of about not 470, $220. So for every $220, you get $30. That may not seem like a lot. If you do 20 of them, you get $600. Right, this scales incredibly well, especially on very, very liquid stocks. All of a sudden, instead of earning $50 per trade, you're earning $500 per trade. All of a sudden, instead of getting $300 a week, you're getting $3,000 a week. It scales exceptionally well, and it has good risk management, and it also has the odds further in your favor. Okay, so in this particular case, entering at 31, and then if Nike pulls back even further, then I add to the trade. This helps to remove the psychological problems in the trade because I sort of root for just a little bit more of a pullback in the stock so I can add to the trade. This is called averaging in, and I'm sure you've heard the phrase losers average losers. That doesn't apply in this case because you're planning your risk out. Okay, this is all pre-planned position sizing. You don't see this anywhere else, right? And here's the beautiful thing. If you use good till cancel orders, you can automate your entries. Okay, so this trade worked out really well. You're looking to pull 15 to 20% return on your risk out of the trade, and then you move on. If you can capture 10 to 20% on a trade, every single trade and every single week, the sucker scales so well. Any questions about what we talked about? And I'm going to go ahead and talk really quick. So while the questions come in, I'm going to offer you a special opportunity to get access to Swing Trade Secrets. This shows you all of my trade setups and the ones that I take time and time again, month after month in this market. So one thing I want to do really quick is just show you what the course looks like inside. So this is the, see if it'll load. Man, if my server breaks while I do this, here we go. This is all of the courses available inside of my site, and Swing Trade Secrets is the one that I use to trade directionally. You get module 1, the foundation, and that's going to be, what is that, 369 videos. You get the tools. and all of the studies that I use and the custom indicators that I use. You also get all of the setups, the RSI retrace, moon setup, Icarus, stop loss profits, 3 standard deviation lower low, J-hook magnets, and a conclusion right there. You also get trading resources, a white paper on foolproof option buying, all my scans, the turning point indicator, option psychology trading PDF called Mastering Your Mind, my option trading watch list, how to use market cycles. You also get a swing trade journal and another custom study with standard deviations. All of this is available for you with just this one course. So you learn how to identify stop loss profits, which is a beautiful thing because it allows you to view the market in terms of who's on, excuse me, who's on the other side of the trade. You get 4 major secrets that give you a framework for stock price movement, how to find magnet levels, and quantitative studies and scans for you to find the best stocks to trade. Also, you'll get the Mastering Your Mind ebook. You also get the Foolproof Option Buying ebook, and you also get my custom study, the Turning Point Indicator. So all of that is available for one single payment of $97. You can get that at investingwithoptions.com/swing. That will take you to my secure order form. Enter your name and payment information in that, and you will get access to the course. And then you can also see what else we have to offer at Investing with Options. We have other products and services. So this is an introductory course. That's why it's priced so stinking low, because it allows you to get to know me, get to know my approach, and how I can help you better to use options to build aggressive and sustainable wealth in your portfolio. All right, any other questions before we wrap up? I think that's going to be it. I think we caught us back up on time, so the next presenter will be available there. And in the chat box, there's also a link that you can click, investingwithoptions.com/swing. That will take you to our secure order form, and that should wrap it up for now. Thank you all so much for coming out to this. And I just want to take one more quick look at the market because I am multitasking. Again, right here, the longer the S&P holds above 3150, the higher the odds that we will continue to see movement headed into the end of the year. All right, I'm not too sure that this tariff news is going to be a sell the news event just yet. If we do see extension into 3200, I will be looking to get a little bit more bearish. Or if this sucker goes into a range, that's where credit spreads come into play. Okay, so if let's just say things fall apart and we see a proper dip, what's probably going to happen is that anyone who is over-hedged using S&P puts or VIX calls will close out those hedges, and it will provide a natural floor in the market. And into that natural floor is where I like to deploy all those put credit spreads as well. All right, thank you so much for coming out. That's going to be it for me. I'm going to hand it back over, and I'll see you on the next class. Take care.
All right. Well, hello, everybody. I see No Show says hi to me specifically. That's awesome. Well, great to be here, and I got a really great presentation. So let's get it started. So we'll switch slides here. Oh, this is just a little intro of some of my accomplishments. So we'll zip through that here pretty quickly. You didn't come to hear about me, but you know, these are all companies that I've worked with, continue to work with, and some books and so forth that, and obviously, you know, these companies are major companies, so they have vetted me before they invited me to come and train their traders. If you want to get my full bio, feel free to go to topdogtrading.com, click on the About Me tab, and you'll see the entire bio there. And also, as Anna mentioned, I do have a podcast, so it is appropriately called the Top Dog Trading Podcast. And of course, as all podcasts, it's totally free. I do put some things on here that I don't put anywhere else, so go enjoy it. That's my first gift to you, first Christmas gift. And you can get it pretty much anywhere the podcasts are available. In fact, I think it's on all the different platforms. And enjoy. You know, I love podcasts. I listen to other people's podcasts. They're just great for when you're in the car or at the gym. And, you know, I go between music and podcasts. So enrich my soul and then enrich my mind. And highly encourage you to check it out. We've gotten some great feedback. Oh, in fact, yeah, we got pushed up to number 10 there. That's on iTunes, even ahead of Jim Cramer's Mad Money. So that's pretty amazing. And that, of course, happens by, well, people voting, liking, commenting, so forth. I don't know what iTunes algorithm is on this, but anyway, I'm just really excited, happy, and grateful that a lot of you out there have promoted the podcast. So I know you've seen legal disclaimers before today, but I know also that people come in and out of multi-speaker presentations like this. So just want to share with you maybe a little different slant on the legal disclaimers. So obviously they're very, very, very important, but they're not just legalese. Take these legal disclaimers as research done for you. They are a gift. The regulators have gone out and discovered, why do most people lose money trading? And of course, I think we all know most people do lose money trading. So why is that? What the heck? What's going on? So the regulators went out there, they researched it, and they've given us these what they call disclaimers, but and they are that, of course, but they're also really a gift to you. So even if you've read this before, you know, we see them everywhere, and I think that almost makes people stop looking at them for a while. Go back, check it out, read it, really say, okay, how is this helping me with my trading? In other words, how's it protecting me? I need to read this stuff and realize this is the truth, and trading is risky. And here are the ways in which it's risky. I need to be careful. I need to have my eyes wide open. You know, there's so much hype in this industry that we need to counterbalance that hype with these statements, which is the reality. So please do that. Very, very important. The first aspect of trading is risk management. And this is what is helping you do. And it's also helping you keep your feet on the floor when we get bombarded with all the hype from the marketers. All right, so today we're going to talk about price action, trading pure price action, and we'll see how it goes on time. I think we're going to have enough time to make it all the way through, maybe even have some time for questions at the end. But we're going to start with the very, 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 very basics for those people who are brand new. And then we're going to get more and more complex, go to kind of medium level, intermediate level, and then we're going to go to advanced level stuff. So we got everybody covered here, no matter what level of trader you are. So for those of us who are new, or for those of you who are new, what is a bar? A bar is that, that green thing right there. So I'm using Japanese candlestick patterns, and real quickly, I think most people probably know what this is, but for the few who don't, real quick, we'll just let you know that this represents the low of the market during this period of time, whatever period of time it is. I don't think it says there, but if it's a 5-minute bar, then that'd be for 5 minutes. If it's a daily bar, it'd be for a whole day. And that means, so let's just take the daily example, that the market reached its low here and it reached its high there during that period of time. So that is called a Japanese candlestick. Now, the real body, what we call the real body, is the colored part, the green part. When it's green, it means it opened here and closed there. Okay, so that now there's two things that are significant, and I'm not going to go through all the detailed Japanese candlestick patterns, because I think if you understand the concept behind them, the general concepts, which I'm going to share with you right now, you'll be able to get the vast majority of the learning that you need with candlesticks. And after you learn these few basic things, you'll be able to really read candlestick bars accurately without having to, get an entire encyclopedia. If you want to go that far with it, that's great. Different people specialize in different things, but so I'm going to give you, what covers the vast majority of cases. All right, so here's the two things that are important: the length of the bar from the low to the high. And then the other thing is, where does it close? The length of the real body also, and then where does it open, where does it close? Okay, so let's go on to the next bar. That's, by the way, those two things give it significance. So there's your bar, there's a bearish bar. Okay, so the last one was bullish. This one is a bearish 1 bar price pattern. And again, wide range from high to low. And it closes down here toward the bottom of the range. And therefore, those two things put together give us a 1 bar bearish pattern. Now, here's another 1 bar bearish pattern. We're going to put together multiple bars here first, but these are my 2 favorites. So this one is, we have a wide range bar that gives it significance. But now the open and the close are very close together down here. So again, this is a bearish bar. And what this represents is, this is literally what represents rejection of value of these prices up here. And after all was said and done, this is where the market closed. That's where the market participants, after all the auction that went back and forth, the market decided, okay, for this day, or if it's a 5-minute bar, for this 5 minutes, that's what the market has decided it is worth. All right, just like you heard from the last presenter, it's a bid auction marketplace. That's 100% true. That's really what makes the whole market go round. It all comes down to that. That's the very foundation. And then it's mapped with these price patterns. So again, that would be a bearish bar. Now, the fact that, this is very important too, the fact that the real body is green, when it's a narrow range real body, I don't really give that any credence. I'm not too worried about that. It's still, because the markets have a bit of randomness to them, a bit of chaos, a bit of noise, and you can't expect that, you know, where it goes to the penny, pip, or tick, or to the, if I really want to get myopic, to the pixel on your monitor, that's giving a little too much efficiency to the market. The markets have a little range of noise in them all. You got to figure, you got people all over the world trading, you got people trading different styles, different indicators, different time frames. And all that means that, you know, market's going to have a little bit of noise within it, and don't take every little penny too seriously. Okay, so let's get off of that and get to our next slide. So that'd be just the opposite. This would be a bearish bar. Now, I did this intentionally where I had the real body red on a bullish bar, because again, I don't want you to give too much credence to this. Normally what I would do is I divide it in like thirds. So if it closes in the upper third and we have a long wick down here, okay, then that's still bullish because it's rejected all these prices over here. Market came down, tested them, and all the market participants together decided, nah, this is the value of the market during this day, if it's a daily bar. Okay, tried all these, rejected them. Couldn't get enough traction down here, came all the way back. So those are the 2 primary types of candlesticks that we're looking at today. All right, then we have a 2-bar pattern. And so the second bar, it negates the first bar. So the first bar, we've got kind of a bearish pattern here. And then the next bar, we've got a bullish pattern. So market could turn around that fast when you're just looking at individual bars. Again, don't get too enamored with any one bar. That's the lesson here. You got to take everything together. What Alan Farley talks about, the landscape of the market. All right, and there is a 2-bar bearish pattern. So the second bar negates the first bar. Okay, a 2-bar bearish pattern again. Why a bearish pattern? Because even though we had a green bar before that, we have this rejection of value, these long wicks. That's what I refer to as rejection of value. Market did trade at these prices, but just a smidge, just a little bit. And then after all was said and done, the market said, nah, we're closing there. That's where value is found after these 2 bars now, 2 bars put together. Okay, so now we go to the next one. Pretty simple stuff here. I know, a little below your pay grade for some of you, but we'll get this expanded out here in just a minute. And so then that is a bullish pattern. Again, rejection of value to the downside. So we've got basically, semi-bearish pattern here. Why do I say semi? Because it's not a wide range bar. Then we get a wide range bar from high to low, and it closes in the top third. In fact, it closes way the heck up there. And so therefore these prices rejected, and therefore 2-bar bullish pattern. Okay, now let's take this puppy and let's bring it up to the next level. Oh, so what I was talking about before was wide range bars, right? Two qualifications for meaningful bars. One is wide range and the other is the real body. So wide range means from high to low. Now this is what I would consider a neutral bar. So in Japanese candlesticks, they'll call it like a spinning top. And that's fine, it is, but there's just no wide range on the bar from high to low. And that's all I really need to know on that, by the way. The real body is inconsequential when the bar from high to low is very, very narrow. So that's just neutral. Anything, to me, at least, anything that has a narrow range from high to low is a neutral bar. That's it. That's all I need to know. Don't even worry about the real body. So narrow range, neutral bar, meaning this bar was bullish. This bar is nothing. It's not bullish. It's not bearish. Therefore, when you read the 2-bar pattern, we're still bullish because the second bar is not negated nor confirmed the first bar. And so at this point, we're just waiting. The market's just waiting is basically all it's doing. It's just in a point of indecision. And quite often these will go higher, but again, you got to take into consideration everything else. Here we're just looking at price bar logic. Okay, so now let's put some bars together to kind of look at, okay, how do we take this information we have so far and how do we apply this to multi-bars? Okay, so right here we have a, for our first green bar. So let me ask you, and feel free to participate, by the way, type your questions into the question box or your answers into the question box. So is this pattern here negating this move down? In other words, does this bar validate or invalidate the price action of the bar that precedes them? So go ahead and type that in. Let's get a little interaction going here. I'm live, you're live. Good thing to be alive. I like being alive. So yeah, you didn't know you were going to be quizzed today, did you? Yep, going to be quizzed. The market will quiz you. And the problem is that when it quizzes you, you either make or lose money. I'm letting you be quizzed without risking any money whatsoever. So go ahead, type into the question box if you think that this green bar negates the action of these red bars before it, or if it doesn't. Okay, so now we're using a 1, 2, 3, 4 bar pattern. All right. So let's see, Flynn, thank you. Neil, thank you. Okay, so the answer is, again, here's the question for the bars marked, that one here in this case. Do they validate or invalidate the price action of the bar that precedes them? So here's the deal. First of all, it doesn't validate or invalidate. It's just a neutral bar. So the high to the low range is narrow. The real body, narrow. But the whole thing, all I need to really know is high to low, narrow. So therefore, it's a neutral bar. Now, what our minds do is they play a trick on us. And that's because you can see, you know, this is a historical chart, so you can see what happens. And so your mind has a type of, a prejudice or a perception that I see it goes up, even if you're not saying this to yourself. Your subconscious mind says, you know, oh, it went up after the words, therefore that must have been a turning point. So the green bar must have invalidated the red bars before it and shown a turning point. So that is not true. Okay, so I kind of messed with you here a little bit by showing you a pattern that went up, and therefore your mind just kind of puts it together and said, yep, that must have been a turning point in the market. Green bar must have invalidated the red bars, but no. It's just, again, you got to look at the thing itself without being swayed by the price action that comes after it. It is a neutral bar. Neither validates or invalidates, means nothing, just a pause. Now, the fact that it goes up after that, what does that mean? Well, It went up after that. That's history. But was there just based on these price bars and their patterns that I've shown you so far, was there an indication based on the candlesticks that the market would go up from there? And the answer is no way, no. So how would you know it's going to go up after that? You don't. That's a hard thing for traders to deal with, because we want to think that we can find every swing high and every swing low, and that there should have been a way to catch that. And if we're really trading and it goes up and we didn't trade it, which by the way, there was no reason to trade that bar, but if it goes up like it did and you're trading in real time, then your mind tends to say, oh, how could I have caught that? How could I have caught that? And that's kind of a dangerous question, because the assumption behind that is that you should be able to catch every swing high and every swing low. And the truth is, no, you can't. Nobody does. Nobody. So then you just let it go. Now, then you have what's called trader's remorse. And that's where you say, oh, dang it, I missed that trade. Did you really? What is a trade? A trade is a high probability entry that fits all your criteria, your rules, your methodology. That's a trade. A move in the market should never be called a trade. Only setups that match your proven statistical rules based on statistical probabilities. Those are trades. Market's going to do all kinds of stuff. And just because it moved up or just because it moved down doesn't mean that you should have traded it. In fact, the truth is, most of the time you shouldn't have, because most moves in the market up or down are not preceded by a high probability statistical mathematical situation. Most of them are not. So we do what's called waiting for the market to come to us. We wait till there is one, and then we trade that. So what about up here? This red bar. Did this red bar validate or invalidate the price action before it? Type that in. Now you might be a little bit shy, but that's okay. I will not embarrass anybody, I promise. I will not call out any names unless you give a right answer. So this bar here, this red bar here, does that bar validate or invalidate the bars before it? Well, again, now you can see that it goes down, but this one actually did give us a good signal. And that is that, what, it's a wide range bar, going back to our rules on candlesticks, our basic rules. It's a wide range bar, and it closed toward the low, and it enveloped that bar too. So that did invalidate the price action before it. Goes down, 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 down. Notice this bar, by the way, here's a good example. We've got a longer wick on the bottom. We've got the open and the close at the top. Was this a rejection of value down here? No. Why? Because it's not a wide range bar from high to low. Wide range bars are all neutral bars. So don't care if it's red, don't care if it's green, don't care if it's got a, if it opens and closes near the high or the low. Just because it's a narrow range bar means the market is just kind of hanging around waiting. What about that? Is that a bearish bar? No. Again, has a little higher, well, opens and closes toward the low. Again, just too narrow range to really mean that the market, the supply demand of the market is imbalanced. So there's a balance. When you have a narrow range bar, what it literally means is there's not a dramatic imbalance of supply demand. Okay, it might be slight, but not enough for me to put my money on. So it kind of confirms in a small way the down move, but again, it just doesn't really matter. Now this one, what about this one? Oh, there we got a wide range bar, and it closes at the high. Again, envelops the bar before it. So that one I would say, yeah, this one does invalidate the price bar before it. Okay, so seeing these two different principles apply in multi-bar patterns hopefully helps you out a little bit. Now let's do a couple of more quizzes here. So add a little more complexity to it. Again, multi-bar patterns, but now we looked at a historical chart. Now let's move it over to a real-time chart. In other words, where we're looking at the hard red edge of the screen. because that's how we got to trade, right? We got to trade on the hard edges of the screen. So I don't know about you. I mean, I would love to trade historical charts, but my broker's kind of rude. He won't let me do that. I really am miffed with my broker for not letting me trade historical charts because I'm a master of trading historical charts. But no, we got to trade like this. So another quiz for you. All right, so we gap down, obviously, and right there. So this bar right here, where I've got the blue arrow underneath. Your question is, based on the price bar formation, what would you expect to happen next? Up, down, sideways, and if you want extra points, then type in Y. Go ahead and type that in if you want to really show off. Show off to people here, get the admiration of all the people in this presentation. Get your 15 minutes of fame right here, right now, today. Mark this day on your calendar, 12/12/19. I became famous. I got my 15 minutes of fame. Okay, so let's see what questions or answers we have here. All right. Thank you, Neil. Thank you, Flynn. Good answers. I agree with you. So here's how I look at it. I'll give you a little more detail on it. So we gap down. Awesome. Then we have a question. Are we going to fill the gap, or are we going to do a gap and go? A gap and go means it will continue to go down and not fill the gap. So what evidence do we have? This is how I look at trading. Evidence. Pieces of evidence. The more pieces of uncorrelated evidences, is that a right word? More pieces of evidence, I think you just say evidence, that we have, the higher the probability of the trade. Okay, so we got a gap. Japanese call this an open window, by the way. Since we're talking about Japanese candlesticks, we might as well use their terminology. It does not close right away. It actually goes down. So it starts to look like a gap and go. Then it comes back up, comes back within this territory. Notice all four of these bars, the real bodies, are pretty much exactly the same. So this is neutral. Market's waiting. It's uncertain, right? They're like, are we going to close the gap? We're going to gap and go. So like typical market stuff where they don't like us. Market, do you ever feel like the market doesn't like you? It's always doing the opposite of what you're doing to try to mess you up. There's actually something to that, but we won't get into that today. And then it goes down. Ooh, big red bar. But then it comes back up. And then, yes, this bar here, and I love this. Neil, good job, by the way, Neil. He mentioned a long wick down here, which is exactly right. So we got rejection of value of these prices. What's it doing? It's retesting this low. Now everybody in their parakeet sees this low. Market comes off of it, comes back to it. So now the question is, will it hold that or will it break through? Well, the best answer that we have, at least with the evidence on the chart so far, is that it rejected the values down here at this low and opened and closed up here. Opened, went down, tested, couldn't get enough traction, couldn't get enough people on the other side of the trade. And so they decided, no, the value is up here. So how does that carry over then? Of course, hopefully it's becoming a little more clear now. So then what happens is the market, drum roll please, there you go, closes the gap. And that is our evidence that that was what was most likely to happen. So you wait for some sort of evidence. It was almost, I hate to say it, but almost too easy in this case. Lots, very clear evidence in price action. And then just goes up and closes that gap. Okay, here's another one. How are we doing on time? Pretty good. Okay. So this next one, we have a nice big move up. Whoops, lost my drawing tool there. There we go. Nice move up. Okay, why do I have this blue line here? Simply because this provides resistance. So major swing highs, major swing lows, I always draw horizontal lines at them because they do provide potential support resistance, right? There are places where the market has had a shift in supply demand in previous times. So when the market goes back to that level, then it's going to, well, the market participants are going to say, wait a minute, at this level in the past, here it's just, what, 8 bars ago or so, market participants wouldn't pay anymore. They wouldn't pay anymore. They thought it was overpriced. And so the market went down a bit, but now we've come to retest it, or to test it, I should say. It's not really a retest, it's a test since it was first established here. Now notice we don't quite get to the line. Now some people draw the lines off of the highs. I think that's not preferable because again, we get some noise in the market. So I go out for the real bodies and touch a few real bodies there and draw it there. It's a more conservative place to draw your resistance levels because again, that's where the market found value. Now, even with that though, notice we don't actually touch the lines here or touch the line. And again, that's because you can, the market's not looking at that line that is on your chart. Like this is a 5-minute chart. Well, some people are looking at it on a 60-minute chart. Some are looking at it on a 144 tick chart. Some are using Renko bars. Some are using point and figure. So this is why you're not going to get exact movement to this, the high or the low to the penny, pip, or tick, or to your line. In fact, support resistance levels are not really lines. They're zones which allow for that little bit of chaos. But anyway, Flynn, good, down. We got a nice big red bar that negates the green bar before it, and coming off of resistance. So now we're adding, just to be clear, just to state hopefully the obvious, now we're combining price bars with support resistance. We've brought in a second tool, another piece of evidence to support our case. So price bars and support resistance should always be used together. These are the levels where decisions are being made. And we've got to decide. The basic decision is it going to continue to go above resistance, or is it going to hold resistance and bounce back down? Or, of course, it could just meander sideways. So we've got to look at those three choices and look for evidence. But the evidence is at these levels. So with that, then we bring in our candlestick bars and we say, okay, what do we expect? A break, a bounce off, or nothing. It just goes sideways. Okay, so that we put all the pieces of evidence together, that's what we got, and indeed it does go down. Now, what about this one? Boy, I'm keeping you guys busy today. So what about this one? What will happen next? So we're looking at the right edge of the screen again. There's our little blue arrow indicating that's the bar we're looking at. So hard right edge of the screen, what do you expect is going to happen after this bar? Type it in, give your answer, up, down, sideways. I have no clue. Whatever your answer is, type it in and let's see how you're following along here. In fact, I'll give you guys 1,000 top dog trading admiration points if you get this right. And those admiration points are worth a lot of money because you can take 1,000 of those points and you can go to Starbucks, and with that and a $20 bill, you can get probably a homeopathic amount of caffeine in a quarter cup of coffee, maybe just the hot water. Okay, so let's go here and answer the question. Well, let's just see what the market actually did. That is the answer, is what the market did. And it continued to go up. So then, of course, the question is, well, how would we have determined that? What's the evidence? And the evidence is back to your support resistance. So if I'm going to go back one here, there we go. So what we had here, which I didn't point out, by the way, so I will acknowledge I was being a little tricky, is that we had resistance here. Whoa, that's not exactly a straight line. But anyway, we had resistance here. Remember me saying that previous highs provide potential resistance? But now look where it closed. Way up here, wide range bar, closed above that resistance. See, I didn't draw the resistance on purpose because I want you to start seeing this stuff yourself. If I just point everything out, then you don't learn it. So I point it out first, then I give you the quiz without all the evidence clearly on there to see to see if you can see it for yourself without me making it obvious. So now here's the exact same situation. Here's where that blue arrow was that we looked at. This is the bar we were looking at on the hard right edge of the screen. So wide range bar closed above the high of that resistance. So that indicates that, wow, we got a lot of demand, very little supply. So we've got a lot of buyers and an imbalance of supply demand because it just sliced through that resistance like it was butter. Now, actually, there's another example here, which is just the opposite. Here, market's coming down, get a wide range red bar this time, closes at the low. Is that a bearish bar? Yes, that is a 1 bar bearish pattern. But again, remember, after we looked at that, then we had to open it up and say, all right, what else is on our charts? What are the other pieces of evidences? Evidence. So 1 bar alone is not tradable. That's not enough evidence. So it's one piece of evidence, but not enough. So here we have this major cycle low here. We draw our support line out. Now the question when it comes down into here is, will it go through? Will it bounce off? Or will it go sideways? So we look at the price action to see what does it do at these levels? Well, what's it do is it stops. Does not close down here, right? Doesn't close below support, whereas this did close above resistance. Pauses, neutral, neutral, and now we go up. So putting together price bars with support resistance is just absolutely critical, absolutely critical. So now let's talk about volume. Do we have time to do it? Yeah, we got enough time to go into volume. So volume and price and support resistance. These are all 3 very important things you put together. Now, I have to, well, here's a very important distinction. When you look at the volume histogram at the bottom of your charts, you may not be seeing the real significance of volume. Depends on the market you're trading, but for example, there is the important distinction between volume, what is important volume and what is not as important volume, is whether it's large volume versus small volume. So that refers to, do we have the big whales in here? Do we have the institutions, the pension plans, the banks? That's the big money or the smart money, if you want to call it that. Small volume is, well, obviously, fewer contracts, fewer shares, etc. We want enough volume, but not too much. That's another distinction. If you get too much volume at the end of a trend or at an extended trend, that could be a blow-off move. That could be an exhaustion move. All right, so you want enough volume to have power to push it. You got to have money behind a move in order to make that move follow through. But again, if you get too much, it could be an exhaustion pattern. But we don't want just large volume. Like I said, we want that smart volume, the professional participation. And I might just be nice and show you how to distinguish that. Because retail volume could actually be a counter indication, right? The retail volume, those are the people who are not making money. So you got to be able to compare professional volume versus retail volume. So here's how we do it. I'm going to show you the technique, the tactic, exactly how to do it. So I've got time and sales up here. So on your charting platform, look for time and sales. If you have any questions about that, contact your software provider because, well, they know their software better than anyone, and they can help you get this set up if they offer it. Not all charting platforms offer it, but most do. So time and sales, this is different than your quote window, by the way. So what time and sales is it tracks every trade, every individual trade, one by one that goes through. So at 12:40 or 59, we had that trade. At 12:59 and 57, you know, on and on and on. You get the idea. These all came in around the same time, right? Within 1 minute, we got all of these trades. Okay, now this column here, you can usually on your charting platform edit that a little bit. So by default, it usually includes trades, bids, and asks. Bids and asks are not filled trades, right? They're offerings that are put out there, and they hope someone takes the trade. So I take the bid and the ask out. I deselect those in the filter of that column, and I only want to see the actual trades. These are the filled trades. These are the trades that actually occurred, money changed hands. So that's what I want to see. You could look at the bid and ask if you want to, really get into trading the tape, as they say. That would be fine. I don't do that. There's a little too much. You really got to be an expert to be a tape reader by looking at the bid and the ask. So I want to just see. To me, what matters is, well, actions speak louder than words. So the words are people who are saying, yeah, I'm going to put in a bid. I'll bid this amount, or I'll put in an ask. I'll ask for this amount. Those trades don't always get filled. Those don't always get filled. So until somebody actually commits their money, now I know they're committed. If they just throw a bid or an ask out there, I don't know if they even mean to have that order fulfilled. They may not. They might just be putting out some feelers. They call them feelers. Nothing wrong with that. People, professional traders, sometimes actually put trades in the market, helps them get a visceral feel of what's going on. For others, they're just trying to move the market by showing a big, offer or a big bid away from where the market's currently trading, and everybody looks at that and says, "Oh my gosh, somebody wants to really buy this because there's a lot of demand over here." And then before it gets filled, it kind of evaporates into the air, goes away. So I don't trust all that stuff. What I do trust is people and their commitment to money. I know they're very serious about that, so I changed that only to looking at trades that are filled, because now they're committed traders. Okay, here's the price where they actually got filled, and here's the size. So this means, okay, this person who traded that, they traded 20 contracts on that one trade. It's not cumulative, it's one trade. 43 here, 22 there. So now I filter this column as well. And you can filter this column by the size of the contract. So I decided on this one, it's the NQ, $5 per tick. And so this person, they're trading 20 contracts. So think people who trade futures. How many contracts do they normally trade? Do they trade like 20, 43 at one time on one trade? No, most of them are doing one contract, maybe two, maybe three, maybe four. Most of them not 20. So that's why I filter this. And you go into the little dialog window there, and you just say minimum of 20 contracts. Again, you can pick whatever number you want. The point is to create a demarcation between how many contracts an amateur would trade and how many a professional would trade, because I don't want to see the amateur trades. I only want to see the professional trades that were filled. Now, here in this situation is kind of roughly 50-50 between green and red. I'm not trading this right now. Okay, professional traders, smart money traders, they don't make money on all their trades either. And they could be doing things, they might be entering, they may be exiting, right, taking profits. So a balanced situation like this is not something that we really want to trade. So we see their trades. This is how to see where the smart money is. But right now, yeah, it's kind of split. Oh, this is really cool. Now, not very many charting platforms have this, but I thought I'd bring it up for those who do. So see this chart here, and down here, the volume. But what's weird about this? What's weird is that not every bar has a volume bar below it. That's because all I'm plotting here are what are called block trades. So a block trade is, again, in this scenario, I set it to 20. You can set it to whatever you want, but I set it to 20. So it's only going to show, this is a block trade indicator. It's only going to show the block trade volumes here. So I know that all the rest is amateur volume, or at least the big people are not coming in with big size yet. All right, so like for example here, this is a second retrace in the trend, a wave 4, and it's going up. I'd be very interested in that, because at that low, big professional volume is coming in. Remember, it's not just big volume. It's not just a big histogram down there in the volume, but it is professional money, people who have a lot of money in their trading accounts, big accounts, and they're buying that. I'd like to go with the smart money as opposed to the, well, what? Unsmart money. Okay. So this is an X-ray, if you will, into what the smart money is doing. Would that be helpful? Would you like to trade with them or against them? Now, here's another thing that I kind of came up with this myself. Well, I think I did. Well, I know I did, but every time I say I've got something unique, then somebody else comes along and says, oh yeah, Billy Bob's House of Trading, they teach that too. I'm like, oh, really? So I guess there's nothing new under the sun. But anyway, here's something that I started doing a long, long time ago and found it really helpful. So again, like anything in trading, this doesn't happen all the time, but we're waiting, making the market come to us, meaning we have our strategies, and when the market lines up with our strategy, that's when we trade. When it doesn't, we don't. And we don't care what the market does. We don't have buyer's remorse. We just let it go because we just say, well, there was no high probability entry there, so I didn't take it and I did the right thing. So here's one of the setups that I will look for. I'll put up 2 time and sales windows. And when I put up 2, I'm going to have one where I filter the size down to 1 or 2 contracts. And then in the other one, I used a filter here, this time of 10 or more contracts. And I put them side by side. As you can see, the prices are the same. 1205.75, 1205.75, all the way down, right? So we're looking at the same market at the same time, but what are we seeing here? We're seeing, okay, what are the people with small accounts? I mean, literally, that's what it is. Small accounts, big accounts, but that kind of equates to, you know, amateurs and professionals. So we see that the amateurs are selling across the board. They are selling. What are the professionals doing? They're buying. They're buying. So which side of the market do you want to be on? Now that you've got an X-ray into the smart money trades and you got an X-ray into the amateur trades, remember, 2 types of volume, amateur and retail, which is amateur, or professional. We're only interested in the professional. Actually, if you think about it, retail volume might actually be an indicator too, but a counter indicator, because most amateurs lose, as we started saying at the very beginning, and I think you already knew that. So whatever they're doing is what we don't want to do. So actually it is kind of an indicator, but I only do that if we've got the professionals. So I'm really following the professionals. I'm not just counter trading the amateurs, I'm trading the professionals. But when I see this kind of distinction where it's a real imbalance, then yeah, that's sweet. That's sweet. All right, so now let's finish up here real quick. And let's see. Oh, yeah, there's another distinction too, if you want to take this even further. This is NinjaTrader. So again, some time and sales have more flexibility than others as far as editing them. So NinjaTrader has this cool thing too, where you can add a couple more distinctions if you really want to get into this. So one of them is you can color code, not just green and red, but you can make it a different color, like I decided lime green. That's personal choice, obviously. But what the lime green means, as opposed to the regular green, is that someone bought, there you go, I was going to say buyed. Man, good thing you don't have to be good at English to be a good trader. So what they did was they bought above the ask. So they kind of overpaid for it, right? They didn't even get in the spread. They bought outside above the spread. So that's an aggressive buy. That's an aggressive buy. And then here is they sold below the bid. So it's kind of a little harder to tell here, but that's actually magenta, and then that's red. So these people were very aggressive in their selling or shorting. And so they were willing to take more slippage on the trade. So aggressive. Okay, so that's one distinction you can make. And then another one here on NinjaTrader, at least they allow for this, where you could set a second level of plotting on your time and sales window. And they've got another column here. So we set this at a minimum of 20 contracts. Okay, nothing shows up here unless it's 20 contracts or more. And then I added in this column, okay, but I also want to just throw it right into my hazel orbs there, another level, and this one set at 50. So these are people with really big accounts. And then it plots block, which stands for block trade. So you're going to see two levels of professional trading now. So you're going to see anything 20 or above. Okay, and let's look at those. So we've got red, green, red, green, red, green, red. So a little bit to the bearish side, but still kind of mixed. Somebody aggressively bought. But what do the block trades say? Remember, there are only 50 contracts. These block trades aggressively shorting. So all the block trades, the people with big accounts of 50 contracts or more on one trade. Now remember, if they're trading 50 contracts on one trade, how big is their trading account? Huge, right? Because they're only going to risk a small percentage of their trading account on any one given trade. So the dominance here is to the downside and aggressively on 1, 2, 3 trades. All right. So, by the way, which way did it go? These came in first, went down. All right. So, you guys finding this helpful? Is this something new that you haven't seen before? Maybe, hopefully. So one last thing here that I'll show you before we finish up, and I share with you my offer, which, by the way, I don't have anything to sell today, so total freebie offer today. I'm not even going to take your money. Keep your wallets and your purses hidden. Put them in a lockbox because you're not going to need it for me. All right. So here's another common issue: breakout trades. So we are in this range of that high, that low. Market just kind of bouncing off the highs, bouncing off the lows. When are we going to get a breakout of this puppy? So getting false breakouts is it's just the heavy burden on the breakout traders. Then there's a lot of false breakouts these days. So what's a piece of evidence we could add that would say, all right, this breakout's going to follow through and not come back into the range and be a false breakout? Well, there it is. There's your block trade. And it is coming in above the high after it broke out. So now we got power, we got mass, we got momentum, we got professional volume. Big orders coming through, and that is what creates the follow through to the upside and helps improve the probability that we're not going to have a false breakout. So really powerful for those. So here's my offer, by the way, today. So again, nothing for sale, just a free course of mine. I'm going to give you to test out Top Dog Trading. So I'm going to give you my rubber band trade strategy. So this is not, again, just, some general ideas or theories or concepts, but with this, you're actually going to get a trade strategy, a trade setup that that you can take and hopefully make some money with it. So try before you buy, or try and never buy. Either way, I like to provide people with proof. And the only proof that really, matters is if you can trade it, if you can make money with it. Just because someone else can show you their trading statements, that's all well, that's all good. Okay, they're a great trader. But can you trade it? Does it fit your personality style? And can you get in the swing? And can you understand it? So that's what I'm doing. I'm giving you a free trade setup, my rubber band trade strategy. Test it out. No charge, no credit card even needed. And here's what you're going to do. It comes as part of my little mini course here. You're going to get 5 days of video instruction. You're going to get interactive quizzes. So just like I did today, I gave you some quizzes here. Nobody's going to know what your answers are. That's only between you and you, but it helps make sure that you get it right. So if you misunderstand something, it'll be pointed out to you right there, and you're like, oh, cool, I need to course correct. Also, I'm going to offer you my cycle indicator. Again, absolutely free. Now, that takes about an hour to get set up in your charts and to teach you how to use. So I'll do that on a separate webinar, absolutely free. And get everything, all this stuff, all you have to do is to go to one link, Barry Burns, or I'm sorry, topdogtrading.com/free.